Welcome back to the audiobook Reading Price Charts Bar by Al Brooks, here on Trading for Life. In this session, we're diving into chapters 6 through 10, which continue building your foundational skills in price action trading, one bar at a time. Let's take a brief look at what each chapter covers. Chapter 6, First Entries and Second Entries. Al Brooks introduces the powerful concept of first entries versus second entries, a key part of his trading methodology. First entries often occur after a trend line break. Second entries are considered higher probability setups, especially in counter-trend trades. You'll learn how to identify these with clarity, increasing your trade accuracy by understanding the deeper story behind retracements and reattempts. Chapter 7, Signal Bars and Setups. Here, Brooks focuses on signal bars, which are crucial for deciding when to enter a trade. He breaks down what makes a good signal bar, like size, body-to-wick ratio, and context. You'll also understand setup bars that precede strong moves, giving you the confidence to pull the trigger at the right time. Chapter 8, Entry Bars and Follow-Through. Once a trade is entered, how do you evaluate its quality? This chapter teaches you to interpret entry bars and the follow-through that confirms or invalidates your setup. You'll grasp how to stay in winning trades longer and exit losing trades faster, critical skills for long-term profitability. Chapter 9, Trends, Ranges, and Breakouts. Brooks goes deeper into market structure by explaining how to distinguish between trending and ranging environments. He explains the personality of trends, how they evolve, and when they might end. You'll also learn how to spot false breakouts and trade genuine ones with more conviction. Chapter 10, Trading Ranges, the Price Action Approach. This chapter is dedicated to trading ranges, one of the most common and challenging environments for traders. Brooks gives practical advice on identifying range boundaries, fade setups, and breakout traps. You'll see how to thrive in sideways markets while others get chopped up. If you're serious about mastering price action trading, these chapters are invaluable. Al Brooks teaches not just technical patterns, but how to think like a professional trader. Make sure to subscribe to Trading for Life for more audiobook breakdowns, trading psychology tips, and technical analysis insights. See you in the next chapter. Chapter 6, Breakouts. A breakout is simply a move beyond some prior point of significance, such as a trend line or a prior high or low, including the high or low of the previous bar. To a trader, it implies strength and a possible new trend. For example, if a bull breakout bar has a strong close, and the next several bars also have strong closes and trending highs and lows, no bar pullbacks, then the market will likely be higher than it is at the current moment at some point before the market reverses back beyond the start of the breakout move. The breakout can be of anything, such as a trend line, a trading range, or the high or low of the day or yesterday. It does not matter because they are all traded the same. Fade it if it fails, as most breakouts do, and re-enter in the direction of the breakout if the failed breakout fails, and therefore becomes a breakout pullback. Only rarely is it best to enter on the breakout, and it is almost always better to wait for a failure or a breakout pullback. On most days, traders look at new swing highs and lows as possible fade setups. On a strong trend day, however, the breakouts are usually on huge volume, and there is very little pullback even on an I-minute chart. It is clear that the trend traders are in control. When a trend is that strong, a price action trader will be entering with trend on a high/low I or 2 pullback before and after the breakout, and usually not on the breakout. She is always trying to minimize the risk of the trade. However, once you recognize that a strong trend is underway, entering with trend for any reason is a good trade. In a strong trend, every tick is a with trend entry, so you can simply enter at the market at any point using your swing size and use a reasonable swing stop. Breakout entries in strong trend. When a trend is strong, every breakout beyond a prior extreme is a with trend entry, as can be seen by the huge volume, the large size of the breakout bar a strong trend bar, and the follow though over the next several bars. Smart money is clearly entering on the breakout. However, that is rarely the best way to trade a breakout, and price action traders almost always find an earlier price action entry like a high 1 or 2 in a bull. It is important to recognize that when a trend is strong, you can enter at any time and make a profit if you use an adequate stop. If you miss the earliest entry of a breakout and you are waiting for a pullback, you can enter at the market or on an I-minute pullback. It is best to wait for at least 2 strong trend bars, good size ranges with small tails, or 3 or 4 moderate-sized trend bars, and enter the 1 or 3 minute pullback, using half of your normal size or whatever your swing size is. Allow a pullback test of the breakout, and use the stop that you would use had you entered early and were now swinging a portion. Scalp out half and then move your stop to break-even. Since there is now a strong trend, you should add on or re-enter when there is a pullback. The rally from the bar 4 higher low in figure 6.1 became a strong bull higher low after a trendline break, with 7 bull trend bars in a row as the market reversed through the bar 1 high of the day. With that much momentum, everyone was in agreement that bar 5 would be exceeded before there was a sell-off below the start of the bull at bar 4. Breakout traders would buy above every prior swing high, such as on bars 5, 6, 8, 11, 13, and 16. Price action traders would have entered earlier in every instance on the breakout pullbacks, which were bull flags. For example, at the bar 6 high 1, the bar 8 high 2, the bar 10 failed reversal, the bar 12 high 2 and trendline break not shown, and the bar 15 high 2 test below the EMA. The high 2 was based on the 2 clear, larger legs down from bar 14. Breakout traders are initiating their longs in the exact area where price action traders are selling their longs for a profit. In general, it is not wise to be buying where a lot of smart traders are selling. However, when the market is strong, you can buy anywhere, including above the high, and still make a profit, but the risk-reward ratio is much better on buying pullbacks than it is on buying breakouts. Blindly buying breakouts is foolish, and smart money would not have bought the bar 13 breakout because it was a third push and near a trend channel line. Also, they would not have bought the bar 16 breakout, which was a higher high test of the old high bar 14 after a trendline break, too much risk of a trend reversal. It is far better to fade breakouts when they fail or enter in the direction of the breakout after it pulls back. Yesterday, not shown in figure 6.2, was a trend from the open bull, which is one of the strongest trend patterns, so the odds were high that there would be a pullback, and then a test of the high of the open and likely a bull close. Traders are all watching for a buy setup, expecting follow-through buying from the strong trend of yesterday. Bar 2 was a small higher low and an EMA gap bar second entry. The signal bar had a bear close, but at least its close was above its open. If you did not buy there, you could watch the breakout and decide how to enter. There were 2 large bull trend bars on the trendline breakout, each with strong closes and small tails. Had you gone long at bar 3, you would be swinging a portion of your trade at this point, so you can enter that same position size at the market, using the stop that you would have used had you entered earlier. That stop would now be around the trend line, maybe below the breakout bar. Bar 4 was a pause bar just below yesterday's high, and buying 1 tick above its high is another good entry. A pause bar is a possible reversal setup, so buying above its high will be going long where the early bears are buying back their shorts, and where the longs who exited early would also be buying back their longs. At this point, the trend is clear and strong, and you should be buying every pullback. Bar 8 is the only reasonable countertrend scalp, a failed breakout to a new high after a trendline break, since it is a strong bear reversal bar and an expanding triangle top, but the trend is still up. Note that there has not yet been a close below the EMA, and the market has been above the EMA for more than 2 hours. Bar 9 is an inside bar after the first close below the EMA, so a test of the high is the minimum target. Breakout pullbacks and breakout tests. After a breakout, eventually there will be a pullback. If the breakout pullback comes back to within a few ticks of the entry price, it is a breakout test. The test can occur on the bar after the breakout or even 20 or more bars later, or both. This test bar is a potential signal bar, and look to place an entry order at 1 tick beyond it in case the test is successful and the trend resumes. It is a particularly reliable breakout pullback setup. If there is a pullback within a bar or 2 of the breakout has failed. However, even the strongest breakouts will have a 1 or 2 bar failure that in fact becomes just a breakout pullback instead of a reversal. Once the trend resumes, the failed breakout will have failed, which is the case in all breakout pullbacks. Since they are failed failures, they are second entries and therefore have an excellent chance of setting up a profitable trade. A breakout pullback is also referred to as a cup and handle. Breakout pullbacks can happen in the absence of an actual breakout. If the market strongly runs close to the breakout, but does not exceed the old extreme, and then quietly pulls back for 1 to 4 bars or so, this will likely function exactly like a breakout pullback, and it should be traded as if the pullback followed an actual breakout. Remember that when something is close to a textbook pattern, it will usually behave like a textbook pattern. If there was a strong move or a first leg of a trend earlier in the day, then a with-trend breakout later in the day is more likely to be successful, and a failure will likely fail and become a breakout pullback. However, if most of the day has been trendless with 1 or 2 bar breakouts in both directions, the odds of a failure leading to a reversal are increased. After an initial run, many traders will take partial profits and then place a break-even stop on the balance. The break-even stop is not necessarily exact on every trade. Depending on the stock, a trader might be willing to risk 10 or even 30 or more cents, and it is still basically a break-even stop, even though the trader will be losing money. For example, if GOOG is trading at $750 and a trader just took partial profits on half and wants to protect the rest, but GOOG recently has been running break-even stops by 10 to 20 cents, but rarely by 30 cents. The trader might place his break-even stop at 30 cents beyond the breakout, even though it would result in at least a 30-cent loss and not a break-even trade. In the past year or so, Opal and RIM have been very respectful of exact break-even stops, and most breakout pullback tests in fact end about 5 cents shy of the entry price. GS, on the other hand, routinely runs the stops before the pullback ends, so a trader would have to be willing to risk a little if he is trying to hold on to his position. Alternatively, he could exit at break-even and then re-enter on a stop at 1 tick beyond the test bar, but he will invariably be getting back in at 60 or more cents worse than his initial entry. If the price action is still good, it makes more sense to hold through the breakout test and risk maybe 10 cents than getting out, and then back in at 60 cents worse. Bar 1 in figure 6.3 is a potential breakout failure, but the breakout was strong and was made of 3 bear trend bars that covered most of the day's range. The market pulled back to the EMA and led to an M2S short. The second bear trend bar was the start of the reversal down from the second leg of the pullback to the EMA. A bull trend bar followed by a bear trend bar and then by a second bull trend bar as a 2-legged move up. Bar 3 again was a potential failed breakout to a new low of the day. This is the second attempt to rally after breaking below the low of the open, and second attempts have a much higher success rate. Also, there was a small reversal bar. Even though it was a doji and not a bull trend bar, it had a bigger bull tail than bear tail, indicating some buying and some weakening of the bears. Also, bars 1 through 2 could be setting up a failed final flag since they are overlapping and largely sideways. Also, the entry bar was a bull trend bar that was almost inside the doji, so this is similar to an Roman 2 pattern, and the bull close of the second bar is a sign of strength. Bar 5 is a pullback from a small rally that broke above a minor swing high and almost broke to a new high of the day. When the market almost breaks out and then pulls back, it will trade as if it had actually broken out and is therefore a variant of a breakout pullback. This bar 5 breakout pullback traded down to only 2 cents below the top of the bar 4 signal bar. And when a stock is trading at $580, it is just about a perfect breakout test and therefore a reliable long setup. Once the actual breakout to the new high for the day occurred, there was a breakout pullback long entry at bar 6, 1 cent above the high of the prior bar. Many stocks are often well behaved and will come back to test the breakout to the exact tick, as LEH did 4 times today in figure 6.4. Since many traders will enter a breakout on a stop at 1 tick beyond the signal bar, an exact pullback like these will run any break-even stop by 1 tick. However, re-entering at 1 tick beyond the test bar is usually a good trade. For example, shorting at 1 penny below the low of bar 2. GS has been notorious for running break-even stops over the past year. Bar 8 in figure 6.5 extended 6 cents above the low of the bar 6 signal bar. Bar 10 hit 2 cents above the bar 9 signal bar low, running an exact break-even stop by 3 cents. The bar 5 high exceeded the swing high of the final hour of yesterday by 2 cents before reversing down. Also overshot the trend channel line drawn across bars 2 and 4, and the trend line breakdown to bar 7 was followed by the bar 8 lower high test of the bull extreme bar 5, leading to a bear swing. Goog formed a series of breakout pullback entries in figure 6.6. The sharp rally off the open broke above the swing high of yesterday, bar 1, and the pullback at bar 5 could not even reach the EMA or the breakout point. And there is strong momentum. Buying a high 1 pullback is a good trade. The signal bar is a small doji inside bar, indicating a loss of selling power following the large bear trend bar. The bears did not follow through. There was a second long entry at bar 6, which was a high 2, even though it is higher than the high 1 of 3 bars earlier. Bar 8 was a breakout test that missed the low of the signal bar by 2 cents. Bar 9 was a breakout test that missed the signal bar low for the bar 8 short by 4 cents. These are just observations and not needed to take the breakout pullback shorts at bars 8 and 9. The 1 bar sell-off at the bar 9 M2S, a low 2 at the EMA, was followed by an inside bar signal bar, creating another breakout pullback short entry on bar 10. Bar 11 broke below the bar 5 pullback and resulted in a breakout pullback short at the EMA at bar 12. This pullback also was a failed breakout of the trend line from bars 7 to 9, not shown. Bar 13 only broke 5 cents below bar 11, but quickly gave a breakout pullback short entry at the bar 14 low 1. Since bar 14 had a bull body, a more cautious trader would have waited for a second entry. The doji bar following bar 14 was an acceptable entry bar, but selling the outside bar that followed this doji bar was even better because it was a low 2. Why was it a low 2? As it followed 2 small legs up. Bar 14 was the first leg up, and the outside bar 2 bars later traded above that small doji bar, creating a second leg up, and the low 2 short entry. Bar 15 was also an outside bar short entry for the pullback following the breakout below bars 11 and 13. It was especially good because there are trapped longs who bought above the bull trend bar, thinking that it was a good false downside breakout reversal. However, there were 4 bear trend bars down from bar 14, and smart traders would have wanted a second entry before going long. Bar 16 was a barb wire low 2 pullback after the breakout below the swing low at yesterday's close, bar 2. Many of these trades are tiny scalps and should not be the focus of the majority of traders. Their significance is that they illustrate a common behavior. Traders should concentrate on trading the bigger turning points, like bars 4, 7, 9, and 12. Chapter 7, Magnets. This chapter has very little to do with trading and is included for completeness because it illustrates some price action tendencies, but these tendencies are not reliable enough to be the basis for trading. If you want to learn how to make money, do not spend much time here and instead focus on the best trades in Chapter 15. Some prices act as magnets, drawing the market toward them. When you become aware of a magnet, trade the market as if it is trending toward the magnet, and do not trade countertrend until after the magnet is tested, unless there is a clear trendline break and then a test of the extreme. Usually the market will overshoot the magnet and reverse, but after the test of the magnet, the market can continue to trend, form a trading range or reverse, and you must wait for more price action before placing your next trade. Measured moves based on the first pullback, AB equals CD. When a market makes a sharp move and then has a pullback, it will likely have a second leg, and the second leg is frequently approximately the same size as the first. This is sometimes called an ABC move or an AB equals CD. A type of ABC, but the B, C, and D correspond to the A, B, and C of the ABC. This is of minor importance because you should not be fading the move with a limit order based on Fibonacci extensions or measured moves or any other magnet. They just provide a guide to keep you trading with trend until they are approached, and at that point, you can consider counter-trend setups as well. In addition to clear pullback entries that set up measured moves, sometimes there is a more subtle situation that is equally valid. When a market has a strong trend move, and then a fairly strong pullback, which then begins to form a trading range, traders can use the approximate middle of the range to project where the second leg of the pullback might reach. As the trading range unfolds, keep adjusting the line where you estimate the midpoint to be, and that will usually be around the midpoint of the pullback once the move has finally completed its second leg. This just serves as a reminder of where you should be anticipating setups for a resumption of the trend. XOM had a strong move from bars A to B in figure 7.1. After the bar C higher low, a trader should be only on the long side to ride the second leg. Bar D slightly undershot the target, the top of the dashed line. Once in the area of the target, traders can consider countertrend trades. If you were to use ABC labeling, bar B is point A, bar C is point B, and bar D is point C. Once there was a higher low at bar E and the rally broke above bar D, a trader could look at a D as a first leg that contains two smaller legs AB and CD, and then stay long until there was a measured move up, AD equals F, and the target is the top of the solid line. Fibonacci traders also look to other extensions, 62%, 150%, 162%, and so on, as valid areas to look for reversals, but this is too complicated and approximate. It is just as easy to make a best guess and then begin to consider countertrend setups in addition to with trend. RIM had a sharp move up to bar 2 in figure 7.2 after an opening reversal reversed yesterday's low, a trend channel line overshoot and reversal, and then there was a pullback. Since a second leg up was likely, if a trader was interested in knowing where it might end, he could keep adjusting line B to be in the middle of the developing range, and then after the market breaks out, make a parallel and drag it equidistant up from line for a measured move. This is just an observation and has nothing to do with trading. It is simply a reminder that the market is likely to go up for a second leg, and you should have a slight bias toward long entries until it is in the area of the measured move. However, you already have that bias since you are expecting the move, and most of the bars are bull trend bars. The pullback to bar 3 was so deep that a trading range was likely, and until the market broke out of the triangle above bar 6, traders could trade in both directions, as with any trading range. Measured moves on breakouts based on thin areas and on flags. This is a minor point, but an interesting observation that can help you to be trading on the correct side of the market. However, if you are spending more than a second thinking about it while trading, you are likely missing good setups. This section is simply here because it is a common price action phenomenon, and it is not a basis for trading. Breakout often forms either a thin area, where there are no overlapping bars or minimal overlap, as the strong momentum carries the market quickly well beyond the breakout, or a fat area, where there is a small trading range. The midpoint of both often becomes the midpoint of the move. The fat area is a trading range, which is an area of agreement on price, and its middle is the middle of what bulls and bears think is fair. A thin area is an area of agreement as well. It is an area where the bulls and bears agree that no trading should take place, and its middle is the midpoint of that area. In both cases, on a simplistic level, if those prices are a midpoint of agreement between bulls and bears, they are a rough guide to the midpoint of the leg that contains them. Once they form, swing part or all of the with trend entries. Once the target is approached, consider counter-trend entries if there is a good setup. Most traders use the height of the prior trading range for measuring, which is fine because the exact distance is only approximate no matter how you do it. Unless you are a Fibonacci or Elliott wave trader and have the uncanny ability to convince yourself that the market almost always creates perfect patterns, despite the overwhelming evidence to the contrary. The key is to trade only with trend, but once the market is in the area of the measured move, you can begin to look for counter-trend entries. However, the best ones always follow a trendline break. If the market pauses again after the measured move has occurred, look at these two strong trend legs as a possible end of a higher time frame correction, instead of the end of a 5-minute bar chart trend, and then plan to swing part of any countertrend entry. Two legs often complete a move and usually result in at least a protracted countertrend move of at least two smaller legs, and sometimes a new, opposite trend. The countertrend move will likely test the trading range that was at the middle of the measured move. Sometimes the projections are exact to the tick, but most of the time the market undershoots or overshoots the target. This approach is only a guideline to keep you trading on the correct side of the market. 2 days with measured moves in figure 7.3 form thin areas on the chart. A thin area is a breakout area where there is essentially no overlap of the bars. The market had a sharp move up from bar 3 on the FOMC report at 11:15 a.m. PST and broke above the bar 2 high of the day. The flag at bar 4 tested the breakout with a two-legged sideways correction, But after the high too long from this flag, the market was left with a thin area between the top of bar 2 and the bottom of bar 4. The bar 4 trading range is also a small fat area that could be used for the measured move. You could use either the low of bar 1 or bar 3 to calculate the measured move. The market reached the line C target from the line A bar 1 to the line B measured move exactly on the last bar of the day, and poked above the line D target, using the bar 3 to line B projection on the open of the next day. Even though bar 1 is higher than bar 3, it can still be considered the bottom of the measured move by thinking of the sell-off to bar 3 as just an overshoot of the bar 1 actual low of the leg. On the second day, there was a thin area below bar 7 and above bar 8, and the line F target was exceeded just before the close. Incidentally, there was also a double top bear flag bars 8 and 9. The move down to the breakout pullback flag around bar 3 in figure 7.4 was steep, and a reasonable target for a measured move down is from the top of the leg bar 2 to the approximate middle of the flag line C. This projected to line D, which was overshot and led to an EMA test. You could also have used the bar 1 high for a measurement, but you should generally look at the start of the current leg for your first target. After the line D target was reached, the line E target based on the bar 1 starting point was hit soon afterwards. Note that the move down to bar 4 from bar 2 was a strong bear with no significant trendline break, so it was best to stick to with trend setups. The 3-bar rally from bar 4 broke a minor trendline and setup, a minor possible final failed flag. But since there has yet to be a sharp rally, like a gap bar above the EMA, countertrend trades have to be scalps if you take them at all. You should only take them if you are a good enough trader to then switch to with trend trades as soon as one develops. If you cannot, you should not be trading countertrend, and instead you should be working hard to take with trend entries. Just being in the area of a measured move is not enough reason for a countertrend entry. You need some earlier countertrend strength. On the second day, there was a flag around bar 10 after the breakout, and this projected up to line H using bar 9 as the starting point. If instead you used the bar 7 low of the day, the target would have been reached shortly after the gap up on the following day. Once there is a breakout flag, it is wise to swing part of your with trend trade until the measured move is reached. At that point, consider a counter-trend trade if there is a good setup. Line B in figure 7.5 is the midpoint of the thin area in between the breakout, the high of bar 2, and the low of the first pullback, the low of bar 5. And the measured move was hit to the exact tick at bar 8. Line E was the midpoint of a thin area, and the market greatly overshot its line F projection. The breakout from the bar 12 bear flag had a huge thin area down to bar 13, but it was so late in the day that a measured move from its midpoint was unlikely. However, at that point the day was clearly a bear trend day, and traders should only be shorting unless there is a clear and strong long scalp. There were a couple in the final hour. The move to bar 7 broke a trend line, indicating that the bears were getting stronger, and the move to bar 9 broke a major trend line, setting up the bar 10 lower high test of the trend extreme bar 8, and the subsequent bear that followed. Reversals often end at signal bars from prior failed reversal. Prior failed reversals often provide targets for the successful reversal when it finally comes. For example, if there is a bear and there have been several bull entries that failed as the market continued to sell off, each of these entry prices, the high of each signal bar, will be targets once the reversal up finally succeeds. The market will often rally all the way to the highest signal bar's high before having a significant pullback. It is not important to understand why this happens. The key is to realize that the market will tend to pull back after it tests those earlier signal bars. It is likely that some traders who entered on those signals scaled in as the market went against them, and they then used their initial entry as their final profit target, exiting break-even on their worst entry and taking profits on all of the other entries. For many traders, it is something of a "thank you, God, I will never do this again" price. You did not exit a loser and your loss keeps growing and you keep hoping for the market to come back to your entry. When it finally does, you exit and swear that you will never make that mistake again. It might just be that smart traders believe this to be the case and will dump their longs at those targets. Or it might simply be one of the many secret handshakes that great traders all know, and they exit there simply because they know that it is a reliable recurring pattern for pullbacks to end near earlier entry points. Also, since the market failed at these points earlier, traders will position themselves believing that the market might again fail, causing the correction to end at these prices. The monthly chart of the SPY in figure 7.6 had a strong bull that ended in 2000, but it had several attempts to reverse on the way up. Each of the bear signal bar lows becomes a target for any correction on the way down. Likewise, the bear that ended in 2003 had several failed bull reversal attempts, and the high of each signal bar becomes a target for any subsequent rally. Finally, the rally since 2003 had several failed bear attempts, and each one is a target in the current downswing. And one of the targets ever has to be reached, but each is a strong magnet that frequently draws the market back to its level. Other price magnets. There are many other price magnets that will tend to draw the market toward them for a test. Here is a list of some of them, and many of these have been discussed earlier in the book. When a market is trending toward a magnet, it is prudent to trade with trend until the magnet is tested and preferably overshot. Do not trade countertrend at the magnet unless there has been some prior countertrend strength like a trendline break. Trend lines. Trend channel lines. Fibonacci retracements and extensions. AB equals CD. Spike and channel. The start of the channel is usually tested within a couple days. This is often followed by a period of consolidation within the area of the channel. As the trading range unfolds, its top and bottom are about the same as the top and bottom of the channel. Failed final flags. After the breakout from the flag, the market comes back to the flag and usually breaks out of the other side. High and low of yesterday. Swing highs and lows of the past few days. Breakout points. The extreme of a trend after every type of pullback. See the chapter on the first pullback sequence. Trading ranges, including tight trading ranges and barbed wire, the extremes in the middle often get tested. Entry bar and signal bar protective stops. Entry price breakout test. Huge trend bar opposite extreme, the low of a huge bull trend bar and the high of a huge bear trend bar. Common targets for scalp and swing positions. In Opal, 50 cents and $1. In the E-mini, 5-6 ticks for a 4-tick scalp and 3 or 4 points for a 2-legged countertrend move. Double the required stop. If an E-mini trade required you to use a 12-tick stop to avoid getting stopped out, expect the move to extend about 12 ticks from your entry. Daily, weekly, and monthly swing highs and lows, bar highs and lows, moving averages, gaps, Fibonacci retracements and extensions and trend lines. Emotional numbers like hundreds in stocks, such as Opal at 100, and thousands in the Dow 12,000. If a stock quickly moves from 50 to 88, it will likely try to test 100. When there is a huge trend bar with small tails, traders who enter on the bar or soon afterwards will often put their protective stops beyond the bar. It is fairly common for the market to work its way to those stops and then reverse back in the direction of the trend bar. Bar 1, in figure 7.7, is a huge bull trend bar with a shaved bottom. The market reversed down off the bear inside bar that followed and formed a higher low, but not before running the protective stops below the low of the trend bar. Smart traders would have shorted the inside bar, but they were ready to go long above the bar 2 bull reversal bar that hit the stops and then turned the market back up. Bars 3 and 4 were also huge trend bars with small tails, but neither was followed by an immediate pullback that ran stops. Incidentally, bar 2 is the start of a channel in a small spike and channel rally, and is a likely magnet on any pullback. The first pullback after any surge commonly gets tested as the market consolidates into a trading range after the move. Here, however, bar 3 tried to form a trading range in the area of the bar 2 low, but it failed, and this resulted in close to a measured move down. Chapter 8. Trend Reversals. The single most important rule in this book is that you should never even be thinking about trading against a trend until after there has been a break of a significant trend line. And even then, you should still be looking for with trend trades, because after this first countertrend surge, the market almost always goes back in the direction of the trend to test the old trend extreme. Only rarely is the trend line break on such strong momentum that the test won't be tradable for at least a scalp. If the market fails again at the price of the old extreme, then it has made 2 attempts to push through that level and failed, and whenever the market tries twice to do something and fails, it usually tries the opposite. It is after this test of the old extreme that you should look for countertrend trades, and only if there is a good setup on the reversal away from the old extreme. A trend reversal, or simply a reversal, is not necessarily an actual reversal. It can be a change from a bull trend to a bear trend or vice versa, or from a bull or bear trend to a trading range, or from a trading range to either a bull or bear trend. It can be as simple as a trendline break. The new trend may be protracted or limited to a single bar. The market may also simply drift sideways after a bar or two, and then trend again later either up or down. Many technicians will not use the term reversal except in hindsight, after a series of trending highs and lows has formed. However, this is not useful in trading because waiting for that to occur will result in a worse risk-reward ratio, since a significant pullback becomes more likely the longer a trend has been in effect. Once a trader is initiating trades in the opposite direction to the trend, that trader believes that the trend has reversed even thought the strict criteria have not yet been met. For example, if he is buying in a bear, he believes that the market will likely not even trade a single tick lower, otherwise he would wait to buy. Since he is buying with the belief that the market will go higher, he believes the trend is now up and therefore a reversal has taken place. Many technicians will not accept this definition, because it does not require some basic components of a trend to exist. Most would agree on two requirements for a trend reversal. The first is an absolute requirement: the move has to break a trend line from the prior trend. The second requirement happens most of the time but is not required. After the trend line break, the market comes back and successfully tests the extreme of the old trend. Rarely, there can be a climactic reversal that has a protracted initial move and never comes close to testing the old extreme. Everyone agrees that a new trend is present once there is then a series of trending higher highs and lows in a bull and lower lows and highs in a bear. Typically, the initial move will break the trend line and then form a pullback that tests the end of the old trend, and traders will look to initiate countertrend, actually with trend, in the direction of the new trend positions after this test. The test may fall short of the prior extreme or it may exceed it, but not by too much. For example, if there is a bear trend and then a sharp move upward that extends well beyond the bear trend line, traders will look to buy on the first pullback, hoping for the first of many higher lows. However, sometimes the pullback extends below the low of the bear trend, running stops on the new longs. If this lower low reverses back up within a few bars, it can lead to a strong swing up. If, however, the lower low extends too far below the prior low, it is best to wait for another trendline break, upward momentum surge, and then a higher or lower low pullback before going long again. Although traders love to buy the first higher low in a new bull or sell the first lower high in a new bear, there first must have been a break of a significant bear trend line. If the trend is good, there will be a series of pullbacks with trending swings, higher highs and lows in a bull and lower highs and lows in a bear. And each pullback can provide an excellent entry. The first pullback, for example, the first higher low in a new bull, can be a test of the bear low or a test of a breakout of a key point like a trend line, prior swing point, trading range, or the moving average, and may not get very close to the bear low. Most trends end with a breakout of a trend channel. For example, a bull typically ends in one of two ways. Either there is an overshoot of the bull trend channel line that fails and is followed by a reversal down and then a break below the bull trend line, or the market can fall through the bull trend line without first overshooting the trend channel line. If the bull ends with a failed breakout of the trend channel line, there will typically be two legs down, and the first pullback will almost always form a lower high, and only rarely a higher high as its test of the bull high. On the other hand, if the bull ends with a trendline break, the test of the bull high can either be a higher high or a lower high, and each occurs about equally frequently. Since at least two legs down are to be expected, a higher high should be followed by two legs down, and a lower high may be followed by a single leg, since the first leg down already occurred just before the lower high formed. If the market forms a higher high in its test of the old extreme, one of the best trades is to sell the first lower high, which is a test of the higher high. In a bear, after a lower low reversal, obviously after an upward momentum surge that broke a major trend line, it is imperative to buy the first higher low because this reinforces the premise that a major bottom is in. An important point is that trends last much longer than most traders would ever imagine. Because of that, most reversal patterns fail, and some become continuation setups, and most continuation patterns succeed. Traders have to be very careful when trading countertrend based on a reversal pattern, but there are price action setups that greatly increase the chances of a profitable trade. If you find yourself drawing many trend channel lines, then you are too eager to find a reversal and are likely missing lots of great with trend trades. Also, since most trend channel line overshoots and reversals are minor in a strong trend and fail, you will be trading lots of losers and wondering why these patterns are failing when they are supposed to be so good. Wait for a trendline break before looking for a countertrend trade, and look at all those minor trend channel line overshoots as with trend setups, and enter where the losers are exiting on their protective stops. You will be much happier, relaxed, and richer, and you will be entertained by how well they work when intuitively they should not. In a bull trend, buyers continue to buy until they decide that the risk-reward ratio is no longer as favorable as they would like it to be, and at that point, they will begin to take partial profits. As the market continues to rise, they will continue to take more profits and will not be eager to buy again until there is a pullback. Also, shorts are being squeezed out of the market as the market continues upward, and they are being forced to buy back their short positions. At some point, they will have covered all that they wish to cover, and their buying will stop. There will also be momentum traders who will continue to buy as long as there is good momentum, but these traders will be quick to take profits once the momentum slows. So who is buying that last tick in a bull or selling the low of a bear? Is it the cumulative effect of countless small traders who are getting caught up in the panic and are being squeezed out, or instead are impulsively buying a rapidly rising bull? If only we could be so influential. That might have been the case long ago, but not in today's market. If there is so much volume at the high and low of the day, and the institutions make up most of that volume, why would they buy the high tick of the day if they are so smart? A large percentage, and possibly the majority of the day's volume, is driven by mathematical models, and some of those models will continue to buy until there is a clear trend change, and only then will they reverse to the short side. They will buy right up to the last tick of a bull, and short to the very low of a bear, because the designers of the systems have determined that this approach maximizes their profit. Because they trade such huge volume, there is an ample supply of buying at the high to take the other side of the huge volume of shorts that is coming in at the top, and vice versa at the bottom. Just because they are very smart and trade huge volume does not mean that they are making a 5% profit a day. In fact, the best of them are netting a fraction of a percent each day, and some of them have determined that their profit is maximized by continuing to buy, even including the high tick of the day. Many also have complex strategies involving options and other products, and it is impossible to know what all the factors are at play at the extremes of the day. For example, they might be expecting a reversal down and be entering a delta neutral spread where they would buy 1 E-mini and buy 2 E-mini at the money puts. They only lose if the market goes sideways in a very tight range for several days. If the market goes up, the puts will lose money at a slower rate than the rate at which the E-mini gains in value. If the market falls, the puts will increase in value faster than the long E-mini will fall in value, and their neutral spread becomes increasingly more of a bear play. This will allow them to profit, even though they bought the E-mini at the high of the day. All that you need to know is that there is huge volume at the extremes, and it is coming from institutions, some of which are buying the high while others are selling it. Incidentally, there is one other common sign of just how active mathematical, computer-generated trading is. Just look at correlated markets, like the E-mini, and all of the related ETFs like the SPY, and you will see that they basically move tick for tick. This is also true for other related markets. This could not be taking place so perfectly all day long if it was being done manually. Also, chart patterns would not be as perfect as they are on all time frames, even down to tick charts, unless a huge volume of the trading was computer-generated. People simply cannot analyze and place orders that quickly in so many markets simultaneously, so the perfection has to be the result of computer-generated trades, and they must make up a large part, if not a majority, of the trading. When there is a strong trend with no significant pullbacks, it is common to start looking for a small reversal, because common sense dictates that the market will eventually have to pull back as traders begin to take partial profits and enough countertrend traders take new positions. A trader will have to decide if it is better to look for a countertrend scalp or wait for the pullback to end and then enter in the direction of the trend. If the trend is strong, it is usually best to only trade countertrend if there are clear signs of a trend reversal, such as a prior trendline breakout and then a test that ends with a strong reversal bar. However, the temptation is great to do something, and many traders will begin to look at smaller time frame charts, like 1 and 3 minute or 100 tick charts. Smaller time frame charts continue to form reversals as the trend progresses, and the vast majority of the reversals fail. A trader can rationalize taking the countertrend trade by thinking that a 1-minute chart has small bars, so the risk is only about 4 ticks, and if this turns out to be the very top of the market, the potential gain is huge. Therefore, taking a few small losses is worth it. Invariably, the few small losses tum into 6 or 7, and their combined effect is a loss that cannot be recovered later in the day. Invariably, when they get lucky and pick the exact end of a trend, they will scalp out with a few ticks profit instead of riding the trade for a long way, as they originally had planned. Death by mathematics. If a trader is becoming agitated because he is not in the market during an extended trend and he feels like he needs to trade, and he begins to look at 1-minute charts, 1-minute reversals offer a very profitable way to make money. However, it is by doing the opposite of the obvious. Wait for a 1-minute reversal to trigger a countertrend entry, which you do not take, and then determine where you would place a protective stop if you had taken the trade. Then, place a with-trend entry stop at that price. You will be stopped into a with-trend position just as the countertrend traders are getting stopped out. No one will be looking to enter countertrend at that point, and likely not until the trend has moved further along and another countertrend setup begins to form. This is a very high probability with trend scalp. The single most reliable countertrend trade is entering countertrend to a pullback, which is a small trend in the opposite direction of the major trend. Once the pullback traders have exhausted themselves, and the trend traders have again demonstrated their resolve by breaking the trend line that contained the pullback, any small pullback to test this breakout is a great breakout pullback entry. This entry is counter to the trend of the pullback, but in the direction of the major trend, and will usually lead to at least a test of the major trend's extreme. The more momentum that is present in the trendline break, the more likely it is that trade will be profitable. Momentum in a reversal can be in the form of a few large trend bars or a trending series of average-looking bars. The more signs of strength, the more reliable is the reversal. Ideally, the first leg of the reversal will extend for many bars, break well beyond the EMA, have the majority of the bars be trend bars in the direction of the new trend, and extend beyond swing points in the prior trend. If the prior trend was a bull, then it is a sign of strength if the first leg of the new bear drops below one or more of the higher lows of that prior bull. Although the best reversals have strong momentum and go a long way, they often are very slow to start and can have several small bars before the sharp moves begin. The market is trying to trap you out of the trade so that you will have to chase the move and add fuel to it. It is common at the very start of a trend to find pullbacks on 1 and 3 minute charts, which trap traders out. Occasionally, there will be one on the 5-minute chart, and it will often turn into an outside bar, trapping you out and forcing you to re-enter the new trend at a much worse price. Some of the strongest trends come from these traps because they tell traders that the last trend trader just got burned and there is no one left from the old trend. Also, they tell us that weak traders just got out and now will be chasing the new trend, adding orders in our direction. This gives traders confidence. When this kind of agitated reversal happens after a trendline break and on the test of the trend's extreme, the new trend will usually last for at least an hour or two and will run for many points. If a trader enters early but the move is hesitant, overlapping bars for a few bars, this should not be a concern, especially if those bars are mostly trend bars in the right direction. This is a sign of strength, and everyone is watching and waiting for the momentum to begin before entering. A good price action trader can often get in before that happens, and then is able to move her stop to break-even soon after the momentum starts, allowing her to make a lot of money with minimal risk. If you are confident in your read, take your trade, And don't worry that no one else sees what you see yet. They eventually will. Make sure to swing part, or even all of your position, even though you sometimes will get stopped out on your break-even stop once or twice before the trend begins its run. When a reversal is gradual, it is traditionally called an area of distribution at the end of a bull or an area of accumulation at the end of a bear. In price action terms, a distribution top can be a double top bull flag, a spike in trading range, or a spike in channel where the channel takes a while to form. An accumulation bottom has corresponding price action patterns. Typically, entries in trend pullbacks look bad but are profitable, and entries in reversals look good but are losers. If you are looking to buy a reversal in a bear or sell a top of a bull, make sure that it is perfect. Trends constantly form reversals that somehow don't look quite right. Maybe there is too much overlap with the prior bars or too many dojis, or the reversal bar is too small or pulls back several ticks just before it closes, or there is no prior break of a significant trend line or failed breakout of a trend channel line. These almost perfect reversals sucker you in and trap you, so you should never take a reversal trade unless it is clear and strong. There is a rhythm to the market as it forms alternating trends. One trend will often end with a trend channel line overshoot and reversal followed by a two-legged move that breaks the trend line. The two legs then allow for the drawing of a channel for the new trend. Some trends end with simply a trend line break and then a test, followed by a second leg. Again, these two legs form a new trend channel that may or may not be the start of a new trend. If the new trend is weak, it will usually just result in a pullback and then a resumption of the old trend. Traders should always be drawing or at least visualizing trend lines and trend channel lines and watching how the market reacts when it tests these lines. Major reversals from bear markets often are volatile with large bars and several pushes up and down. People think that the worst is over and then realize, oops, I'm too early, and they are quick to sell out. This can happen several times before the final bottom is in and accounts for why so many major reversal end with large range bars and either a failed flag or a 3-push pattern. Bar 2, in Figure 8. 1 was a failed final flag reversal leading to a strong move up to bar 3, which exceeded the last lower high of the bear. Bar 4 formed a higher low, which allowed for the drawing of a trend line. Bar 5 pulled back below the trend line and immediately reversed up. However, this now generated a flatter trend line. Bar 6 was a small wedge and the pullback to bar 7 created a new trend line. Bar 8 was a reversal after a wedge top, and that usually leads to 2 legs down. It was also a third push-up. The bar 9 leg fell below the last higher low bar 7 of the bull, indicating bear strength. Bar 9 broke the bull trend line, so 2 legs down are expected. Bar 9 ended the first leg, and it should be followed by a lower high or a higher high. Here, there was a lower high, and the second leg down ended at bar 11. Bar 10 was a strong rally, and this strength could only be negated by a strong move below bar 9, the first leg down. Bar 11 reversed back up after falling just a little below bar 9, so this was likely the end of a two-legged correction in the prior bull. However, this correction broke a major trend line from the bar 2 low, so the market could reverse down after a test of the bar 8 high. Bar 12 formed a two-legged higher high, and the new bear should have at least 2 legs down. It was also a small expanding triangle bar 6, 7, 8, 11, and 12. The first leg down to bar 13 was very strong, dropping well below the bars 8 to 11 bull flag. Once the bar 14 lower high formed, it could be used to create a trend line and then a trend channel line. Bar 15 reversed up from its breakout of the trend channel line, so it should be followed by 2 legs up and a break above the bear trend line, which it was. Bar 16 broke below the first bull trend line and reversed up. Bar 17 was a breakout pullback from the breakout above the bull trend channel line. This rally ended in a small wedge at bar 18, which formed a nominal higher high and an expanding triangle bars 8, 11, 12, 15, and 18. A wedge is a form of a trend channel line overshoot, and 2 legs down are likely. Bar 18 was a double top with bar 12. Bar 19 fell below the bull trend line. Bar 20 formed a lower high, and it allowed for the creation of a trend line and trend channel line. Bar 21 fell below that bar 18-20 trend channel line, not shown, and formed a wedge that began at bar 19. The rally up to bar 22 broke above the last small high of the bear, and it broke above the bear trend line but formed the second lower high in the leg down from the bar 18 high. The test of the bar 22 high failed at bar 23. It did not go above bar 22, so another down leg will form. Bar 24 reversed up after falling below a trend channel line. The rally to bar 25 broke the bear trend line. Bar 26 failed to go above the bar 25 first leg up, and this lower high should have led to a leg down and formed either a new low, which it did, or a two-legged pullback bull flag. It was a double top bear flag. Bar 27 was a two-legged lower low after the bar 25 breaking of the bear trend line. At least two legs up should follow. Bar 28 was a pullback from the two legs up, but it formed a second higher low, so at least two more legs up should form. Bar 30 was a new high after the small bar 29 wedge, so at least two legs down should follow. Bar 31 formed a double top bear flag, a lower high that followed the break of the bull trend line. It is the end of the pullback from the first leg down and should be followed by at least one more leg down. Bar 32 tested the wedge bear trend channel line. The market should either reverse up or collapse. Traders would sell on a stop at one tick below the low of the wedge. Bar 33 was a reversal up from a bear trend channel line overshoot, and it led to a small rally above the trend line. Bar 1 in figure 8.2 was about 10% above yesterday's low, capping off a huge two-day bull in GS. Bar 3 broke the bear trend line in the pullback, and then ran protective sell stops on the two-legged lower low, moved down to the bar 4 reversal bar. This was a great buy setup. You don't have to check, but the first big pullback in a strong trend usually tests the 15-minute EMA, and this one was an almost exact test, but that information was not needed to place the trade. As great a price action buy setup as this was, notice how the entry bar was a small bull trend bar. The market had not yet realized how good this was. It is natural to become nervous when you take what you thought was a great trade in a major stock, but no one else saw it as great yet. Sometimes this happens, and the market can have several small bars, usually with trend, before the bull reversal is perceived as having taken place. That realization occurred during the big bull trend bar, bar 6. Had great momentum and a shaved top and bottom, meaning that the bulls were extremely aggressive and higher prices should follow. By the close of bar 6, your stop is break-even, and you are holding for a test of the bar 1 high. It would be wise to scalp some of your shares out after about the first $1 of profit. Once there has been a strong counter-trend move, there will be a pullback that will be a test for both the bulls and the bears. For example, if there was a strong downward move in a bull market, and the move broke through a trend line that is held for 20 to 40 bars, and the down move continued for 20 bars and carried well below the 20-bar EMA, and even below the low of the last higher low of the bull, then the bears have demonstrated considerable strength. Once this first leg down exhausts itself, bears will begin to take partial profits, and bulls will begin to reinstate their longs. Both will cause the market to move higher, and both bulls and bears will watch this move very carefully. Because the down leg was so strong, both the bulls and bears believe that its low will likely be tested before the market breaks out into a new high. Therefore, as the market rallies, if there is not strong momentum, the new bulls will start to take profits, and the bears will become aggressive and add to their shorts. The rally will likely have many bear bars and tails, both of which indicate that the bulls are weak. The sell-off down from this rally creates the first lower high in a potential new bear. In any case, the odds are high that there will be a second leg down, since both the bulls and bears expect it and will be trading accordingly. Trendline break. The single most important concept in this book is that you should only be trading in the direction of trend lines, and you must wait for the break of a significant trend line before taking a counter-trend position. Virtually all reversals begin with either a trendline break or trend channel line overshoot and reversal, and all of those eventually break the trend line when there is a reversal. The trendline break is what traders need to see before they feel confident about counter-trend positions. Until there is one, most will scalp out of any counter-trend trade. In the absence of a trendline break, there is still a strong trend in effect, and traders should make sure that they take every with-trend entry and don't worry about missing an occasional counter-trend scalp. The best odds and the most money are in the with-trend trades. True V bottoms and tops in the absence of trend channel line overshoots and reversals are so rare that they are not worth considering. Traders should focus on common patterns, And if they miss an occasional rare event, there will always be a pullback where they can start trading with the new trend. Strong trend channel line reversals are from greatly overextended trends and often run far after they break the trend line. First pullback after the reversal is often shallow because the market is emotional and everyone quickly agrees that the trend has reversed. Because of the confidence, traders will be much more aggressive and will add on during the smallest pause and not take profits, keeping the pullbacks small. When there is a strong break of a trend line, there will usually be a second leg after a pullback. The pullback often retraces and tests the old trend line, but there are almost always more reliable price action reasons for entering there in the attempt to catch the second leg of the pullback, or new trend. The stronger the move through the trend line, the more likely it is that there will be a second leg after a pullback. The pullback that tests the trend's extreme can overshoot a higher high in a reversal down from a bull or a lower low at the end of a bear, or undershoot a lower high in a new bear or a higher low in a new bull. If there is an overshoot, but it extends well beyond the old extreme, the reversal is nullified, and the old trend has resumed. Traders need to look for another trend line break or trend channel line overshoot before taking a countertrend trade. Signs of strength of a trend line break: the first leg of a possible reversal include the move covers many points. It goes well past the EMA. In a bear reversal, it extends below the final higher low of the bull, and in a bull reversal, it extends above the final lower high of the bear. It lasts many bars, 10 to 20 or so. There were other strong prior trendline breaks. This isn't the first sign of countertrend strength. The reversal back to test the old trend's extreme lacks momentum, as evidenced by its having many overlapping bars, with many being trend bars in the direction of the new trend. The reversal back to test the old trend's extreme fails at the EMA or the old trend line and does not get close to the extreme. The weak bear leg to bar 4 in figure 8.3 barely broke the trend line, and it did not come close to falling below the last higher low in the bull bar 2, and it could not break through the EMA. However, bar 6 is still an acceptable higher high test of the bar 3 bull extreme, especially since it is a reversal on the open from a breakout of the prior day's high. The bear leg to bar 9 broke below a longer trend line, the EMA, and the last higher low of the bull bar 5, and it followed a previous sharp attempt at a trend reversal, the sell-off to bar 4. Also, the small rally that followed it did not come close to testing the underside of the trend line or the bar 8 first pullback in the first leg down. All of these are signs of strength of the trend line break and increase the chances for at least a second leg down or an actual trend reversal. The pattern was also a head and shoulders top, but it is not worth looking at price action with that in mind. It is better to pay much more attention to the bars closer to where you are thinking of entering. Also, most head and shoulder patterns fail and are not nearly as reliable as the bar-by-bar price action. Bar 10 is a low 4 short in a low momentum lower high test of the trend extreme, bar 6. After the break of a bull trend line, traders would start to draw bear trend lines not shown, and these become increasingly important as the market transforms into a bear trend with a series of lower highs and lows. Trend channel line failed breakouts, climax, parabolas, and V-tops and bottoms. All OF these moves have one thing in common: their slope. Instead OF being linear, a straight line, it is curved and increasing. At some point the market quickly reverses direction, and usually at the very least there will be a protracted sideways move and possibly a trend reversal. All of these patterns are simply trend channel line overshoots and reversals, and therefore they should be traded as such. Giving them special names adds nothing to your trading success. The trend channel line might not be obvious at the moment of the reversal, but once a parabolic move is underway, price action traders are constantly drawing and redrawing trend channel lines and then watching for an overshoot and reversal. The best reversals have large reversal bars and preferably a second entry. The first leg of the reversal will almost always break the trend line, and if it does not, then the reversal is suspect, and a trading range or continuation pattern becomes much more likely. If a second reversal entry fails, the trend will likely resume and run for at least 2 more legs. Countertrend traders are always drawing trend channel lines, hoping for an overshoot and a reversal that will allow for at least a scalp and preferably a 2-legged countertrend move. R2 in figure 8.4 broke a small trend channel line, but there was no earlier countertrend strength, and the setup bar had only a small bull body. Smart traders would wait for a second entry, and if one did not develop, they would view this as a with-trend setup, which it turned out to be. It is a channel in a steep spike and channel bear trend. Notice how the breakout below bar 2 was in the form of a strong bear trend bar. This is because many longs were tempted to enter early on this wedge, and most would not concede that the reversal failed until there was a move below the bar 2 low of the wedge. That is where their protective stops were. Also, many bears will have entry stops there as well because a failed wedge usually runs about the height of the wedge as a minimum, creating a great short entry. Bar 3 overshot another trend channel line, but there was no entry signal, so there were very few trapped bulls. Also, there was no prior bull strength in the form of a break of a bear trend line, so smart traders would only be looking to short. Bar 5 opened well above the bear trend line, but it was essentially a first EMA gap bar, close enough. Its body was large and entirely above the EMA, even though its low was below the EMA, creating a trend from open move down. Bar 6 did not reach the trend channel line, so although it tried to reverse yesterday's low, the move was suspect. When a move approaches a magnet like a trend channel line, most traders would wait for the overshoot and in its absence would want at least a second entry. Also, the signal bar was a doji with only a tiny body, which means that the bulls were not strong. Bar 8 overshot the bear trend channel line, and the signal bar was an inside bar with a good size bull body. This setup was also a second attempt to reverse yesterday's low, a failed final flag by setup after the breakout of the bar 7 flag, creating a dependable opening reversal setup. Signs of strength in the first leg of a reversal. Some reversals result in trend reversals, and others simply in small countertrend swings. Carefully analyzing the price action before and after the reversal helps a trader gauge how much, if any, of his position he should swing, and how big a move to anticipate. When there is a strong trend, traders should not be taking countertrend trades until there has been a trendline break, or at least a climactic reversal from a trend channel line overshoot. In a trading range market, however, traders can trade reversals in both directions. There are many characteristics of strong reversals, and the more that are present, the more likely it is that a countertrend trade will be profitable, and the more aggressive the trader should be in her decision over how much of her position she should swing. The stronger the prior trendline break in a trend reversal, the more likely the reversal will gain more points and last longer and have 2 or more legs. The strongest trendline breaks have strong momentum and surge well past the EMA and usually beyond swing points in the prior trend. Here are many characteristics of strong reversals. Strong reversal bar. Second entry signal. Trap bar, trapping traders out, forming a small higher low in a new bull or lower high in a new bear. Began as a reversal from an overshoot of a trend channel line from the old trend. Reverse a significant swing high or low, such as breaking below a strong prior swing low and reversing up. Break well beyond the trend line of the old trend. Break the EMA by many ticks and close beyond it for many bars. Break above the last lower high of the prior bear or higher low of the prior bull. The pullback from the first countertrend leg forms an M2B or an M2S. The first leg lasts many bars and reverses many bars of the prior trend. Trending anything, closes, highs, lows, or bodies. Small pullbacks, especially if only sideways. Bars with tiny or no tails in either direction. If you do get stopped out, be aware of the possibility that you were trapped out of a great trade and look to re-enter quickly. Here are several examples of trap bars that trap traders out of new trends. Bar 1 in figure 8.5 is a strong bear trend bar and a low one after a strong bear into the prior day's close. There was a big gap down on the open followed by 3 bull trend bars. With this much bull strength on an overdone open, smart traders would not be shorting a low one far from the EMA. The failed low one was a great long entry, a small higher low, because it trapped bulls out and bears in, and both will chase the market up. Bar 3 was an outside bar down. Smart traders would not be buying in here since the market was attempting to reverse from a final bull flag, and they are expecting 2 legs down. Also, small bars after a climax. A large bull trend bar breakout from that flag almost always lead to a protracted move. The market is not in a hurry, as indicated by the small size of the bars. Bar 4 tried to form a large bull trend bar after a big bear trend bar, possibly setting up a trend from the open bull day. It had a close below its midpoint, and it became an inside bar. This bar trapped longs and set up a bear leg. Bar 0.5 was a failed low one, and it became a small higher low that was also a second EMA gap bar with a flat EMA, which is always a good setup for at least a scalp on the long side. Trends reverse with a test, either an undershoot or an overshoot. Trends end with a reversal, a counter-trend move that breaks a trend line, and then a test of the final trend extreme. The test may overshoot the old extreme, as in the case of a lower low in a new bull or a higher high in a new bear, or it may undershoot it with a higher low in a new bull or a lower high in a new bear. Rarely, the test will form a double top or double bottom to the exact tick. Overshoots are strictly speaking the final leg of the old trend because they form the most extreme price in the trend. An undershoot is the pullback from the first leg in the new trend. Tests themselves are frequently made of two legs. For example, at a market top, after the trendline break, the market will almost always rally one more time in a second attempt to drive the market to higher prices. If instead the sellers again overwhelm the buyers around the price level that they did earlier, the bulls will have made two attempts to drive the market higher, and both failed. When the market tries to do something twice, and it fails both times, it usually then tries to do the opposite. Since a counter-trend move after a trendline break usually has at least two legs, if a bull reversal has a higher low for the test of the bear low, it will also be the start of the second leg. On the other hand, if it forms a lower low for the test, that low will be the start of the first leg, and after that first leg, it is likely that there will be a pullback and then a second leg. Likewise, in a bear reversal, a lower high is the start of the second leg, but a higher high test is the start of the first leg. A very common pattern is where there is a strong countertrend move, a spike, without any pullbacks, and this spike could be a trend reversal, but there is then a resumption of the trend. If this resumption has enough bars and retraces enough of the spike, it will make traders wonder if it represents a failed reversal rather than a pullback after a successful reversal. However, the extremes of most of those sharp momentum spikes that have deep, lengthy retracements still end up being tested, and most are exceeded. For example, a large spike down that is followed by a slow rally that retraces most of the spike will usually be followed by a second sell-off that tests the low of the initial spike. At that point, the original trend can continue double bottom bull flag, the reversal can continue down, or the market can enter a trading range. The test is much more likely if the spike is in a trading range or in the direction of the trend, like a spike up in a bull, and it is not likely if it is the first countertrend move in a strong trend. For example, a sharp bear spike in a strong bull will usually just trap bears and not get tested. A climax reversal, usually an overshoot and reversal of a trend channel line, or a climactic failed final flag, does not have to have a pullback that tests the extreme. Climaxes are much more common on smaller time frame charts. For example, a 1-minute chart often has several each day, whereas a 5-minute chart might only have a couple each month. Perfect V top and bottom patterns are rare, and there is nothing to be gained by a trader thinking of these patterns as anything other than a reversal after a failed trend channel line overshoot, and it should be traded as such. Any series of strong trend bars, big bodies, small tails, and very little overlap that is followed by a pullback almost always has a test of its extreme. Bar 3 in figure 8.6 tested and exceeded the bar 1 spike low, but there was no reversal, and the bear continued for several more bars, forming a wedge bottom. Today's open formed a higher low in its test of the wedge at yesterday's low. It was also a double bottom bull flag, with the last swing low of yesterday, and a failed breakout of the large two-legged bear flag of the final 2 hours of yesterday. Bar 5 was the top of a protracted, big rally off the bar 4 bear spike, but the bar 4 spike low was tested at the close of the day, the bar 1 bear spike in figure 8. 7 was tested and exceeded later in the day by a much larger bear spike, the bar 3 low. This second bear spike was tested with the bar 5 higher low. The bar 1, 3, and 6 bear spikes and the bar 4 and 8 bull spikes in figure 8.8 all were tested on this 60-minute Opal chart. Bar 4 is a bull spike in a bear and does not have to be tested, but it was about 10 bars later. Bar 8 is a bull spike in a trading range and a break of a major trend line, so it was likely to be tested. Bar 7 was a new swing low, a lower low and possible bear bottom after a trendline break, but not a spike, so it does not have to be fully tested. Bar 9 formed a higher low test of bar 7 and was a bull reversal. Bar 1 in figure 8.9 was a bear spike in a strong bull and was unlikely to be tested. It was simply the first EMA gap bar, and it trapped bears. Bar 2 was a bear spike that followed a wedge top, making it likely to be tested since at least 2 legs down should be expected. Bar 3 was a bear spike in a bear and was tested with a higher low that led to resumption of the higher time frame bull. RIM closed yesterday with a strong bull spike in figure 8.10, so the odds were excellent that today was going to try to exceed it. Although today's rally was sloppy and did not look particularly bullish, note that the market could not put 2 consecutive closes below the EMA. This chart was going up, but its strength was deceptive. The rally to bar 1 in figure 8.11 broke a bear trend line, and the bar 3 test of the bear low was a 2-legged lower low. A lower low test usually results in at least 2 countertrend legs, and that is what happened here. The up moves from bars 3 and 9. Bar 9 was a higher low after the break of yesterday's major bear trendline, broken by the rally to bar 1. And as a higher low, it is the start of the second leg, and the completed second leg can be the end of the move up. Bar 3 was a lower low after a bear trendline break, so it was a possible major trend reversal. You now need to be looking to buy the first higher low, which occurred at bar 7. It is common for the market to run the break-even stops once or twice before it takes off, so you need to look to buy again and again, swing part of your position, and bar 9 offered a great opportunity. This bar 2 climactic opening reversal, inverted V-top, in the SKF Ultra Short Financials ETF in figure 8.12 was simply a reversal of yesterday's high after breaking out of the top of a bear trend channel line. It was also a second entry after breaking above yesterday's high. Incidentally, it was a measured move up from yesterday's trading range, but this is only a minor consideration when contemplating a trade. When a strong trend reaches an area of a measured move, traders can then begin to consider countertrend trades, but only if there is a good setup. Measured moves are of minor importance and not terribly reliable and, in general, should be ignored. The 5-minute OIR in figure 8.13 had a climactic opening reversal below yesterday's low, and it was also a reversal of 3 trend channel line overshoots. A trader should buy above the large reversal bar 1 and again at the high 2 first pullback at bar 2, expecting at least 2 legs up. Always swing part of your position when 2 legs are likely, because sometimes there will be a protracted new trend rather than just a 2-legged pullback. When there is a strong trend, there will be many reversal attempts on the 3-minute chart and far more on the 1-minute. Until there is a clear reversal on the 5-minute, if you choose to look at the 1 or 3-minute charts, you should treat each reversal attempt as a with-trend setup. In figure 8.14, each of the 5 attempts on this 3-minute chart to reverse attracted eager bulls who thought they were risking little, and they might be gaining a lot if they were catching the bottom of a climactic V-bottom reversal, a very rare event. Rather than joining them, think about where they will have to sell out of their longs and place an entry sell stop at that very location. You will consistently succeed in transferring money from their accounts into yours, which is the primary objective of trading. For example, as soon as the bulls went long at the bar 1 bull reversal bar, there was not a prior trendline break in the steep sell-off, so no longs should be considered. Smart traders would place orders to go short on a stop at 1 tick below the signal bar. Short at bar 4 was below the entry bar, since the bulls would have tightened their stops once the entry bar closed. Since this is a trend, you should swing a large part of your position. Bar 5 was in Roman 2 pattern, which often is a reversal pattern, but it needs an earlier trendline break, and it is commonly the final flag before a 2-legged countertrend move, as was the case here. It represents balance between the bulls and bears, and the breakout is reaching outside of the balance. There is often a strong force pulling it back to the pattern, and usually through the other side. Since there was no prior trendline break, the only breakout that was a valid entry was a bear breakout. However, and Roman 2 is just wide enough to break a small trend line, so any reversal up within a few bars afterwards is a valid long entry of a small failed final flag. This is the 1-minute chart of the same bear move, and the numbered bars are the same as on the prior chart. Bars C, D, and E in Figure 8.15 were valid countertrend setups that followed 2 legs down and small trendline breaks. Each was a tradable long scalp. Although these are possible to trade, it is usually too difficult to read a second chart and place orders this quickly, and you would likely make more money if you just traded with the 5-minute trend. It looks very easy on a chart printed at the end of the day, but is much more difficult in real time. If you were to sell based on the 1-minute chart, all 5 of the numbered bars provided with trend on both the 1 and 5-minute trend, short entries that would allow for swinging part of the position. Here in Figure 8.16 is a 1-minute chart of a 5-minute strong bull not shown. Trading shorts profitably is difficult. None of the 6 shorts above yielded a 4-tick profit. It is far more profitable and less stressful to simply look for with trend entries on the 5-minute chart and never look at the 1-minute. The only valid reason to look at 1-minute short signals is to find long with trend entries. Once a short triggers, look for where the protective stops are and place buy orders there, since the trapped shorts will push the market to your long profit target as they buy back their losers. Some news must have been released that led to a sharp sell-off at 1030 PSD in Figure 8.17. You should never pay attention to the news because it creates a distance between you and what you have to do. It requires thought that you then have to reconcile with the chart, which can only reduce your profit. The chart tells you all that you need to know. Something happened that made the institution sell aggressively, and that is all the information that a trader needs. It is time to look for short setups. Bar 1 in Figure 8.17 was a strong bull trend bar that trapped early buyers who bought the candle pattern or a smaller time frame reversal. A buy was not even triggered on this 5-minute chart, since the next bar did not go above the bar 1 high. These bulls would exit below the low of bar 1 and won't look to buy again until more price action unfolds. Place an order to short on a stop at 1 tick below the low of bar 1, which is where those longs will have their protective stops, and as they cover, they will provide plenty of downside fuel. If it gets hit, you know the trapped longs will get out and not want to buy again soon, and the smart bears will be adding to their shorts. With no one left to buy, the market will almost certainly provide a scalper's profit and likely much more. Incidentally, bar 5 is the 3rd overlapping bar, and at least one of the bars was a doji. All 3 were. This is barb wire, which is usually a continuation pattern, and you should never buy at its high or sell at its low. You fade small bars at its extremes, and you wait for a trend bar breakout to fail, which it did at bar 7, after the 2 prior trend bars broke out of the pattern. Bars 3 and 5 were classic candle pattern traps. Traders who memorize candle reversal patterns will be eager to buy these very large candles with long bull tails because they will see the long tails and the closes near the highs as evidence that the bulls were gaining control. Remember, a doji bar is a 1-bar trading range and you cannot buy above a trading range in a bear. Since the doji is a trading range, it is a bear flag and not a reversal pattern. When you see a big bar with a long tail and a small body in a bear, it tells you that if you buy above its high, you are paying way too much. In a bear, you want to buy low, not at the top of a huge bar with a small body and no prior trendline break. These 2 bars again were perfect candle pattern traps. Bar 5 was even better than bar 3 since it was a gravestone doji, which candle novices worship. Also, the market traded above the high of the bar, confirming the strength of the bulls, and it was a second attempt at a double bottom with bar 3. But what went wrong? When you see these small-bodied big candles in a strong trend where there has yet to be a trendline break, you should get excited because they are great traps and therefore perfect short setups. Just wait for the small bar that always follows, and its lack of upside follow-through makes these early bulls very scared. Everyone knows where those bulls are putting their protective stops, so that is exactly where you will be putting your entry stop to go short. And you see those big doji candles, you too see bullish strength, but then assume that since the price was hovering at the high of those bars and the bulls were now in balance with the bears, the highs of those bars are likely to be in the middle or top of a trading range and not at a bottom. The 2-legged rally to bar 6 broke a trend line, and you now know that the bulls are eager to buy, so a perfect long setup would be a failed breakout to new lows. Smart traders will just wait for a 1 or 2 bar break below bars 3 and 5, and then starting placing buy orders at 1 tick above the high of the prior bar. They will keep moving the orders down if they don't get filled, but if the move continues too far down, they will wait for another trendline break before looking to buy again. The earlier bulls with 2 or 3 losses by now will wait for confirmation this time and will enter late, providing additional fuel for the up move after the price action longs get in. Even though bar 7 had a bear body, at least it closed above its midpoint, indicating some strength. Presumably bulls are a little cautious after losing on entries from bars 1, 3, and 5. Also, it was a failed breakout from barbed wire. The odds were high that this would be a profitable long, and smart traders would have been anticipating it, so there was no excuse to miss it. The entry bar had a bull body, albeit small, which is constructive. Also, it was an inside body variant. Its body was inside the body of the signal bar and is a weaker version of an inside bar, which means that the bears did not take control. At this point, you are feeling confident because your protective stop was not hit on the bar after entry, as was the case for the earlier bulls. The next 3 bars all were bull trend bars with closes above the prior close, so the closes are in a bull trend. Some of the best swings begin with several overlapping bars that make you impatient and worried. It is reasonable to assume that there will be 2 legs up, but almost certainly there will be a stop run down before the second leg. The break-even stop was not hit on the violent move down in bar 8, which turned into a bullish outside bar and the start of the second leg up, a higher low. The targets for the rally are the bull signal bar highs in the bear, the highs of bars 3 and 5 and possibly bar 2. Bar 9 exceeded the final target by 1 tick. The momentum was so strong that the bar 8 low was likely just part of the first leg up and not the start of the second leg up, and there instead should be a bigger pullback and then a second leg up. It ended at bar 11. Bar 11 set up a low too short from the rally up from the bar 8 low. Double top and bottom pullbacks. If a market forms a double bottom after a sell-off, but before the bull takes off, and it then has a pullback that tests just above the double bottom low, this is a double bottom pullback long setup. The market made 2 attempts to go down, and both times the buyers overwhelmed the sellers around the same price level. The double bottom does not have to be exact, and usually the second bottom is slightly lower than the first, making the pattern sometimes look like a head and shoulders pattern. If the second bottom does not at least reach the first, there is a risk that the bottom is only forming a 2-legged sideways to up correction, and it would be better to look for a scalp long rather than a swing. A double bottom or top pullback pattern can be thought of as a 3 push bottom, or a triple bottom, where the third push down did not have strong enough sellers to create a new low. It also can be thought of as 2 failed attempts to exceed the prior extreme, often a low 2, and 2 failed attempts usually lead to a reversal. Some technicians say that triple bottoms and tops always fail and always become continuation patterns, but they require that the 3 extremes be identical to the tick. With that strict definition, the pattern is so rare that it is not worth mentioning. Traders will make much more money by using loose definitions. When something resembles a reliable pattern, it will likely trade like the reliable pattern. This is a reversal pattern and not a continuation pattern, like the double bottom bull flag. Both are long entry setups, but one is the beginning of the trend, a reversal pattern, and the other takes place in an established trend, a continuation pattern, or at least after there has been one strong leg. Likewise, if there is a double top in a bull, and there is then a pullback that reaches close to the high, this double top pullback is a good short setup. The monthly SPY in figure 8.18 had a double bottom pullback buy at the bar 5 outside bar, 1 tick above the high of the prior bar. Bar 4 was slightly below bar 3, but this is common and actually preferable in double bottom pullback buy patterns. These often are head and shoulders patterns. Bars 1 and 2 formed a double top bear flag, a continuation pattern and not a double top, which is a reversal pattern at the end of a bull. Although pundits are saying that since Warren Buffett is buying the collapse in the last bar on the chart, and therefore the bottom is in, there is no price action evidence yet of a bottom, and the tremendous value that Buffett is seeing might become an even far greater value in the months to come. Don't buy just because Buffett is buying. Wait for a break of a bear trend line on the daily chart and then for a test of the low that reverses back up. The momentum down is too strong to be looking to buy at this point. Wait for a price action bottom, which will eventually come. The huge bar might be a sign of exhausted sellers, but until there is price action evidence for a bottom, smart traders who are trading the daily chart are only looking to sell. Bar 1 in Figure 8:19 was the end of a large second leg down and therefore a possible reversal setup. Although the move up to Bar 2 was small, neither Bars 3 nor 4 could take out the low and therefore formed a double bottom bull flag. Bar 6 made an exact test of the Bar 3 low and was unable to drop below it or below the Bar 1 low, so this was a broader double bottom bull flag, with Bar 3 or Bars 3 and 4 forming the first bottom. This is also referred to as accumulation. The institutions were defending the Bar 1 low instead of attempting to run the stops, indicating that they believe that the market is going up. Bar 5 was an EMA gap bar, which often provides the necessary countertrend momentum to lead to a trend reversal. It broke a major trend line, and Bar 6 was a higher low test of the Bar 1 trend extreme. Bar 4 in Figure 8.20 looked like a setup for a double bottom pullback, long, but Bar 3 was 5 cents above the Bar 2 low in a very strong bear. This slightly higher low usually negates the pattern and makes a two-legged bear rally much more likely than a new bull. Also, the first pullback, whatever minor rally that would follow Bar 2, in a strong trend, almost always sets up with trend entry, so it is not wise to be looking for bottoms here. However, the market rallied over $1 from the long entry if a trader took the trade. With the big tails on Bars 2, 3, and 4, and with the market still in the first 90 minutes and therefore prone to opening reversals, it was a reasonable trade. However, the smartest traders would be shorting the EMA test, and if you instead scalped that long, it could be difficult to quickly switch to a shorting mentality. Bar 8 was a double bottom pullback setup, with Bar 7 being 13 cents below the Bar 6 low. But the entry never triggered the bar after Bar 8 was unable to take out the high of Bar 8. Again, bottom picking in a strong bear without a prior strong trendline breaking up leg is not a good approach. This is a trend from the open bear, which is one of the strongest types of bear trends, and you should only be looking to short. You should only be looking for reversals after there has been a strong break of the bear trendline. Bar 1-1 was a third attempt at the bottom formation. Bar 10 was above the low of the first bar, Bar 6, by 2 cents, making the pattern weak at best. In a bear, the smartest traders enter on with trend shorts off the EMA, like the M2s following Bar 8 and the Bar 11 M2S. Bars 1 and 2 in Figure 8.21 formed a double bottom, although at first glance, Bar 1 might be easy to overlook. The bottom of an entry bar has protective stops below it, and it will often be tested, as it was with Bar 2, and 2 moves down to the same level is a double bottom, even if the first one is not a swing low. With the big tail on the bottom of Bar 1, there was almost certainly a 1-minute higher low, and there was. Bar 3 was a deep pullback that tested the double bottom, so it was a second attempt to run the stops, but it could not even get as close as the first attempt, the Bar 2 low, before the bears pulled out and the bulls took control. Bars 4 and 5 created a double bottom bull flag on this trending trading range day, and this double bottom was tested by the Bar 6 pullback, forming a large double bottom pullback. You could call it a triple bottom as well, but that term does not add any trading benefit here, and so it is not worth using. Bar 7 is similar to Bar 1 in that it is also an entry bar. It and Bar 8 formed a subtle double top. Bar 8 tried to run the protective stops above the Bar 7 short entry bar but failed. Bar 9 was a second attempt and failed at an even lower price, creating a double top pullback short setup with an entry on a stop at 1 tick below the low of Bar 9. With all of the dojis and overlapping bars in this pattern, this was likely to result only in a scalp, which it did. When you have to look this hard for a pattern, it is usually better to not trade until a clear and strong pattern develops. This sell-off tested into the top of the middle trading range of this trending trading range day, but reversed back up. Bars 11 and 12 formed a double top, alerting traders to look for a double top pullback short setup. The Bar 13 bull trend bar was an attempt to rally and test the double top, and an attempt to form a high 2, an M2B, and it failed. But it is not wise to short near the bottom of a trading range unless there is a strong setup, and this is not. Bar 14 was a better pullback, but it still did not retrace close enough to the double top for it to be reliable. And again, you would be shorting the low of a trading range on a day composed of bull trending trading ranges. Climax, spike, and trading range reversals. A climax is simply any market that has gone too far, too fast in the eyes of traders, and then reverses. A climactic reversal is a strong momentum move, a spike, with a series of big trend bars that often overshoot a trend channel line, and then reverse. The word spike implies that there was a strong move in one direction, and then immediately afterwards, a strong move in the opposite direction. Reversal move is smaller. Otherwise, instead of a spike and trading range, there would be a clear and strong reversal without the hesitation that takes place in the trading range. In a spike and trading range reversal, instead of quickly moving through the EMA in a strong countertrend move, the market reverses for only a bar or two and then goes sideways and forms a tight trading range that can break out in either direction. It is as if the market tried to form a reversal but couldn't quite complete it, and on a higher time frame, instead of a strong reversal bar, there would be a big bar with a big tail and a close somewhere in the middle. Sometimes a countertrend double top/bottom flag forms within the trading range, providing an additional reason to enter into a trend reversal trade. If a with-trend double top/bottom flag forms, it is a with-trend setup. The reversal leg that leads to the trading range is often relatively small compared to the prior trend, but it usually breaks the trend line, and it can be the first leg of an opposite trend. Despite that, it is still easy to overlook, so whenever there is a climactic move, it is something that you should try to find. It may have a low momentum drift toward the old extreme, which leads to a failed test, a lower high in a bull top or a higher low at a bottom, or it could continue to a new extreme and not be a reversal. If instead it does reverse, the new opposite trend sometimes becomes very strong very fast and often forms a spike and channel trend pattern. An inside bar after a breakout bar can be thought of as a possible miniature spike and trading range reversal setup. The distance from the extreme of the breakout bar to the other extreme of the inside bar is the spike, representing a possible small climax reversal, and the inside bar is the trading range. As with all spike and trading range patterns, the breakout can go either way, and the important thing is to be aware of both possibilities. Once the trend begins, look for with trend setups. Sometimes there can be an impressive spike, then a pullback, and then the start of a channel, only for the channel to fail and reverse directions. In hindsight, that pullback was the spike in the opposite direction and led to the channel. However, once you recognize it, then you know there is a trend, and you should try to take every with trend entry. The Globex 1-minute E-mini in figure 8.22 spiked up on a 5:30 a.m. PST report, but formed a strong reversal bar down at bar 1. Bar 1 was a 3-point tall bar, which is big on a 1-minute chart and therefore qualifies as a possible spike down. Bar 3 was a 2-legged move up, forming a low 2 in the possible new bear. Also, bar 2 was in Roman 2 variation if you only look at the bodies. The body of bar 2 was inside that of bar 1, which was inside that of the prior bull breakout bar, and in Roman 2 indicates indecision. And the move up to bar 3 was a false breakout of the top of the Roman 2. The market went sideways for about 10 bars, which qualifies as a trading range after the down spike. Bar 4 had a minimal break above a minor trend line, and then the market resumed its downtrend. Bar 5 is a second chance entry, a breakout pullback. There was a strong reversal on the first bar of the day, bar 5 in figure 8.23, that overshot a bull trend channel line and then reversed back to the area of the line. Market went sideways for 5 bars and then formed a lower high at bar 7, completing a small trading range after the bar 5 spiked down. It spiked up and reversed down in what had to be a spike down on a 1-minute chart. Bar 9 can be viewed as an expansion of the trading range, a lower high, or a double top bear flag. It is approximately the same level as bar 7, and at least a second attempt to rally to the bar 5 high. The name is irrelevant, but it is a good short setup. The market then trended lower for the rest of the day and accelerated as it fell. Bar 10 is a spike, and the move down to bar 11 is a channel. Yesterday, bar 3 was a spike followed by a channel that began at bar 4. Start of the channel usually gets tested within a day or two. The bar 4 low was taken out with the bear following the spike and trading range top that began with bar 5. but the bar 10 high beginning of the channel down was not tested during the following 2 weeks. Both charts in figure 8.24 are of the same time period of the 5-minute SPY. The run-up to bar 2 was a strong bull spike. After the sharp EMA pullback to bar 3 that broke a trend line, the bull channel began. However, it failed in a two-legged lower high at bar 4. Once the market broke out of the bull channel with the bar 5 pullback, which also broke the major bull trend line, it became obvious that this was not a bull spike and channel day, and that the market was forming a trading range. This became a triangle top and then a spike and channel down. When the EMA gap too long failed at bar 8, it was clear that the bears were in control and that a bear channel was underway, with the push down to bar 5 being the bear spike. At this point, you should try to take all short entries and consider any longs to be scalps in general. It is better to ignore the long setups and just trade with trend when there is a strong trend like this, until there is a climactic overshoot of the bear trend channel line and reversal up. Bar 13 reversed up from breaking 3 such lines. Climax, 3 pushes and wedges, trend channel line overshoots and reversals. Trends often end with a test of the extreme, and the test often has 2 legs, each reaching a greater extreme. See a higher high in a bull or a lower low in a bear. First extreme and then the 2 legs make 3 pushes, which is a well-recognized reversal setup with many names. Very frequently it takes a wedge shape, but sometimes the wedge is only based on the candle bodies instead of the tails. It is not useful for a trader to draw subtle distinctions among the variations because there are enough similarities that they trade the same. For simplicity, think of these 3 push patterns as wedges since most of them end in a climatic wedge-like point. A trend line and trend channel line in a 3 push pattern can be parallel as in a stair pattern, convergent as in a wedge, or divergent as in an expanding triangle. It does not matter because they all behave similarly and you trade them the same. The majority of 3 push patterns reverse after overshooting a trend channel line, and that alone is a reason to enter, even if the actual shape is not a wedge. However, the 3 pushes are often easier to see than the trend channel line overshoot, and that makes the distinction from other trend channel line failures worthwhile. These patterns rarely have a perfect shape, and often trend lines and trend channel lines have to be manipulated to highlight the pattern. For example, the wedge might be only with the candle bodies, so to draw the trend line and trend channel line with a wedge shape, you have to ignore the tails. Other times, the end point of the wedge won't reach the trend channel line. Be flexible, and if there is a 3 push pattern at the end of a big move, even if the pattern is not perfect, trade it as if it were a wedge. However, if it overshoots the trend channel line, the odds of success with the countertrend trade are higher. Also, most trend channel line overshoots have a wedge shape, but it is often so stretched out that it is not worth looking at. The reversal from the overshoot is reason enough to enter. If a wedge triggers an entry but then it fails and the market extends 1 or more ticks beyond the wedge extreme, it will often run quickly to a measured move, about the same height of the wedge. Sometimes, just after failing, it reverses back and creates a second attempt at reversing the trend, and when this happens, the new trend is usually protracted, lasting at least an hour, and it usually has at least 2 legs. Sometimes the second push has more momentum than the first, and if it does, ignore the first and assume that the second is actually the first push. Second and third pushes that follow are 2 attempts to extend the trend, and both failed. 2 legs are always expected after any strong move. When a wedge occurs as a pullback after the first leg of a reversal, it usually does not exceed the start of the trend but sometimes does. In either case, a trader should be looking for the second entry into the possible new trend, expecting the test to hold, for example, in a new bull, as a higher low or lower low. 3 push, low momentum, countertrend moves that last for a couple of hours in the middle of the day are common and set up a thrust into the close, resuming the trend from the open. View this as a type of wedge for the following reasons. It has 3 pushes. There is often a trend channel line overshoot. It often has the shape of a wedge, and it has the same behavior as a wedge. Remember, if you see everything in shades of gray, you will be a much better trader. When there are 3 or more pushes and each breakout is smaller, then this is called shrinking stairs. For example, if there are 3 pushes up in a bull and the second push was 10 ticks above the first and the third was only 7 ticks above the second, then this is a shrinking stair pattern. It is a sign of waning momentum and increases the odds that there will be a two-legged reversal. Sometimes there will be a fourth or fifth step in a strong trend, but since the momentum is waning, countertrend trades can usually be taken. On the other hand, if the third step is significantly beyond the second and then reverses, this is likely a trend channel line overshoot and reversal entry. Sometimes the third push undershoots the second one and forms more of a double top, but the meaning is the same, and it is still a reversal setup. When the third push greatly undershoots the second, a head and shoulders reversal pattern forms. Remember that sometimes a failed final flag grows into a wedge flag that often becomes a second, larger failed final flag. For example, in a bear failed final flag, the highest point of the bear flag becomes the first point of the wedge and the failed breakout becomes the second. The two or more legged rally that follows becomes the rest of the wedge, which is a large bear flag. It might become a failed final flag and then reverse the market up, or it can be a continuation pattern in a larger bear, or the market can go sideways. The shorts enter on a stop at one tick below the failure bar near the top of the range, and the longs buy on a stop at one tick above the failed breakout bar near the low of the range. Breaking out beyond any swing high or low, even if it was part of an earlier and opposite trend, is a sign of strength and a potential trade setup. Notice that bar 12 in figure 8.25 rallied above a swing high in the prior downtrend, and then failed after the pause bar that followed bar 12 was also 3 pushes up, and a failed trend channel line breakout created by using the highs of the first 2 minor swing highs on the day. But this is not shown. Several trades were also failed trend line and failed trend channel line breakouts as well. Bars 2, 3, and 6 also represent a shrinking stair pattern, which often leads to a good reversal. With shrinking stairs, the second breakout is smaller than the first, indicating loss of momentum. Here, bar 3 is 19 cents above bar 2, but bar 6 is only 12 cents above bar 3. Whenever shrinking stairs are present, the trade becomes more likely to be successful and usually signals an imminent two-legged pullback in a strong trend. Bar 3 is an example of a failed final flag that expanded into a wedge or sorts. The first leg of the wedge, the first push down, is the low of the final flag, on the bar before bar 3. Bar 3 is the second leg. The 2 legs down to bar 4 make up the rest of the 3 pushes down. This became a larger bull flag that ultimately was the last one in the bull swing. Shrinking stairs, with each breakout extending less than the prior one, signal waning momentum and increase the odds that a profitable countertrend trade is near. After the bar 4 step in figure 8.26, the move to bar 5 broke the trend line, setting the stage for a test of the bar 4 low and a likely two-legged rally, which occurred after the bar 6 lower low. Bars 3-5 show a failed final flag growing into a wedge bear flag, which became a larger failed final flag. The daily SPY topped in March 2000, and then there was a 3-push rally to bar 8 in figure 8.27. Bar 8 also fanned a double top bear flag with bar 2. It slightly exceeded the bar 2 high. Bar 8 did not quite reach the bear trend channel line. This wedge lower high was followed by a huge bear. The daily Dow in figure 8.28 broke a major trend line in a two-legged move down to bar 6, well below the EMA. There was then a small 3 push-up move that formed the lower high at bar 7 that led to the 1987 crash. Bars 3, 4, and 5 in figure 8.29 formed a wedge, but bar 5 did not overshoot the trend channel line. The bar 5 inside bar with a bear close was a reasonable low 2 short setup. Bar 6 was a second entry on the failed high 2. This was a small spike and trading range top as well. Bars 7, 8, and 9 created a 3-push long setup with an entry above the bar 9 bull reversal bar, even though the close was mid-range. The day was clearly not a trend day, so a weaker reversal bar is acceptable. This pattern had diverging lines, although it was not an expanding triangle since the high after bar 8 was below the high after bar 7. Bar 9 did not overshoot the trend channel line, but it was still a good long setup on a trading range day. Expanding triangles. An expanding triangle is a type of 3-push pattern and can be either a reversal or a continuation pattern and is made of at least 5 swings, sometimes 7, and rarely 9, each one greater than the prior. Part of its strength comes from its trapping traders. In a bullish reversal, it has enough strength to rally above the last lower high, trapping longs in, and then collapsing to a new low, trapping longs out and bears in, and then reversing up, forcing both sides to chase the market up. In a bear reversal, it does the opposite. Bears are trapped in by a lower low, then they are forced out, and bulls get trapped in by a higher high, and both then have to chase the market down as the market reverses down for the final time. The initial target is extending beyond the opposite side of the triangle, where the market often then sets up an expanding triangle flag, a continuation pattern in the opposite direction. The term triangle is misleading because the pattern often does not look anything like a triangle. The salient point is that it is a series of progressively greater higher highs and lower lows that continue to trap breakout traders, and at some point they capitulate, and then all of the traders are on the same side, creating a trend. It has 3 pushes and can be viewed as a variation of a 3-push reversal pattern, but with deep pullbacks. For example, in a reversal of a bear swing, both pullbacks form higher highs, but in a conventional 3-push pattern like a wedge, both pullbacks would form lower highs, i.e., not an expanding pattern. The E-mini in figure 8.30 ran up off an opening reversal from the bar 6 gap pullback test of the EMA and yesterday's close. Yesterday's low at bar 5 formed an expanding triangle bottom, a reversal pattern, since the trend was down prior to the triangle, which often runs to a new swing high and then forms an expanding triangle bear flag continuation pattern. It did that at the bar 7 overshoot of the bull trend channel line. The triangle was formed by bars 2, 3, 4, 5, and 7. After a trend channel line failed breakout, especially when there is an expanding triangle, there is usually a 2-legged move down. Incidentally, expanding triangles don't have to have a perfect shape, and they do not have to touch the trend channel lines. Bar 5 fell short. The rally up to bar 7 was very strong, but the low too short was worth taking under these circumstances, an expanding triangle and a small failed final flag. Bar 8 was the second doji in a row, and dojis represent an equilibrium between bears and bulls. Since they are in balance, that balance point is often the midpoint of the move down and is a rough guide for how much further down the market might go in its search for enough buying power to swing the market back up. The target was hit at bar 9, but the market did not rally until after overshooting the bear trend channel line and reversing up at bar 10. Bar 10 also tested the original long entry above the bar 6 signal bar to the exact tick, a perfect breakout test. In an expanding triangle reversal pattern, the lows keep getting lower and the highs keep getting higher. Typically, there are 5 turns before the reversal, but sometimes 7, as in the 5-minute SPY above. There are usually valid reasons to scalp each leg. For example, each leg is a new swing high or low, but once the 5th leg is complete, a larger trend can develop and it is wise to swing part of the position. Also, once the pattern completes, it usually sets up an expanding triangle pattern in the opposite direction. If the first was a reversal pattern, then the next part of this pattern, which will be in the opposite direction, if it develops, will be a continuation pattern and vice versa. Bar 5 in figure 8.31 was then the 5th leg, bar 1 was the first, and therefore a buy setup for at least 2 legs up. However, bar 6 was a failed breakout short setup and a small wedge, creating an expanding triangle bear flag. The first of its 5 swings is bar 2. The 7th leg had a second entry at bar 8. Bar 7 was the first setup at a new low, but it failed, as expected since the entry was above a barbed wire pattern and should not be taken. Bar 10 tested the bar 8, but its low was 1 tick higher. However, as a test of yesterday's low and a high 2 and EMA gap 2 bar, it was a good opening reversal. It was also similar to a 9th leg of an expanding triangle, and in trading, similar is usually good enough. Bar 11 was a breakout pullback from taking out the high of the open, even though it did not break above the bar 9 high of the triangle. Bar 12 was a low 2 and a 1-tick bear breakout failure on this SPY chart. It traded 1 tick below the prior bar, but then traded above its high. The E-mini chart, however, held above the reversal bar's low and did not trigger the short. The E-mini gives fewer false signals because each tick is 25 cents, and a false signal would have to be a 25-cent move, which is equivalent to 2.5 cents in the SPY. Since there was no significant bull trendline break, the up momentum was strong. This is not a short setup. Bar 13 is a second entry for the breakout failure short above bar 9, but again, there was no trendline break earlier in the rally, so it would be unwise to short in the absence of some earlier bear strength. Instead of breakout failures, bars 12 and 13 were breakout pullbacks. Bars 1-5 in figure 8.32 created the 5 legs of the expanding triangle bottom. The entry is 1 tick above the bar 5 lower low. Bar 6 failed to take out the high of bar 4 before dropping to a new low. Bar 7 is a second chance entry at the expanding triangle bottom. But with this many bars between bars 5 and 7, the triangle has lost its influence, and this is now just a reversal from a new low in the day. Bar 8 formed a higher low that was also a double bottom, bars 5 and 7 pullback long. After reaching the target of a new swing high, bar 9 set up an expanding triangle bear flag bars 2, 3, 4, 7, and 9, and this short has a target of below the bar 7 low. Eventually, however, one of these increasing larger triangles fails and a trend begins. Incidentally, the market gapped below bar 7 on the open of the next day, reaching the target. Chapter 9: Minor Reversals, Failures. Every pattern fails some of the time, and traders should accept that as a normal occurrence, which sometimes offers other opportunities. Also, the failure can fail, resulting in a resumption of the original move. A failure is any trade that does not reach its goal, resulting in either a smaller profit or, more commonly, a loss. For a scalper, the goal is a scalper's profit. But if a trader was expecting more and the market failed to meet his expectation, even if it provided a scalper's profit, it is still a failure. Failures are often excellent setups for trades in the opposite direction, since the traders who were just forced out will be hesitant to re-enter in the same direction, making the market one-sided. In addition, as they exit with their losses, they drive the market even further in the opposite direction. If a trade makes a scalper's profit, and therefore the trader exited some or all of his position, and then comes back and takes out the original signal or entry bar stops, there is much less fuel left in the market to drive the market in this new direction because there are far fewer traders who are trapped. Also, many of the scalpers would exit the balance of their positions at break-even after taking partial profits, so their stops would be tighter than the original ones beyond the entry or signal bars. Although a minor reversal might just be a reversal in a trading range that is good for only a scalp, it can sometimes tum into or be a part of a major reversal of a trend. Single most reliable minor reversal is one that takes place at the end of a pullback in a strong trend, especially near the EMA, because you are then entering in the direction of a larger trend, and it is reasonable to expect at least a test of the prior extreme of the trend. Any reversal pattern, including major reversal patterns, can fail and result in the resumption of a trend. Failed signal and entry bars and one-tick failed breakouts. When traders enter a trade, many place a protective stop at one tick beyond the signal bar. After the entry bar closes, many move it to one tick beyond the entry bar. How do you know this? By simply looking at charts. Look at any chart and find possible signal and entry bars and see what happens when a bar reverses beyond them. So much of the time, the reversal will be in the form of a strong trend bar, and most of the time the move will be enough for at least a scalper's profit. This is because once traders get flushed out of a new position with a loss, they become more cautious and want more price action before re-entering in the same direction. This leaves the market in the hands of just one side, so the move is usually fast and big enough for a scalp. Why is a one-tick failed breakout so common, especially in the E-minis? With stocks, failures often come on 1 to 10 cent breakouts, depending on the price of the stock and the personality of the stock. Every stock has distinct characteristics in its trading, presumably because many of the same people trade it every day. So a small group of traders trading sufficient volume can move the market enough to create recurring patterns. If the market is sideways to down in a weak bull, many traders will believe that if the current bar extends one tick above the prior bar, traders will buy there on a stop. Most smart traders will expect this. However, if enough other traders with enough volume feel that the correction has not extended deep enough or long enough, for example, if they believe that a two-legged move is likely, those traders might actually go short at one tick above the prior bar. If their volume overwhelms the new longs and not enough new longs come to the rescue, the market will likely trade down for a tick or two. At this point, the new longs are feeling nervous. If their entry was at such a great price, why didn't more buyers come in? Also, now that the market is even a tick or two cheaper, this should look like even better value to traders looking to get long, which should quickly drive the price up. But the longer the market stays down even just a couple ticks, the more new bulls will become concerned that they may be wrong. Some will start selling out at the market, adding to the offers, and others will place sell-exit stop orders at 1 or 2 ticks lower, maybe basing these orders on a 1 or 3 minute chart with the order 1 tick below the most recent bar. Once these are hit, these new buyers will also become sellers, pushing the price further down. Also, the original shorts will sense that the new longs are trapped, and many will increase their short positions. As price falls 3, 4, or 5 ticks, the stopped-out buyers will switch from looking to buy to waiting for more price action to unfold. In the absence of buyers, price will continue to fall in search of enough bids to satisfy the sellers. At some point, sellers will begin to cover and take profits, slowing the price fall, and buyers will again begin to buy. Once the buying pressure overtakes the selling pressure, the price will then go up again. A 1-tick failure is a common source of losses for a new trader. The trader will see what he believes is a good setup, for example, a buy, and he confidently places a buy stop order at 1 tick above the high of the prior bar. As expected, the market ticks up and hits his entry stop, making him long. The very next tick is 1 tick lower, then 2, then 3, and within 30 seconds, he loses 2 points as he watches his protective stop get hit. He wonders how anyone could be selling exactly where he was buying. It was such a great setup. Almost invariably, he was buying countertrend before there was a sign of bullish strength, like a prior surge above a bear trend line. Or he was buying above a huge doji with a tiny body at the top of barbed wire, or a bear flag that he misread as a reversal, overcome by his eagerness to get in early in what he perceived as an overdone bear. A third common situation is when there is a huge trend bar with a tiny tail or no tail. If it is a bull trend bar, lots of traders will put their protective stops at 1 tick below the bar. It is common for the market to work its way down and hit the stops, trapping traders out, and then reversing back up in the direction of the trend bar. Finally, breakout tests often test the entry price to the exact tick, trapping out weak hands who will then have to chase the market and re-enter at a much worse price. What that novice trader doesn't realize is that lots of big traders view these as great short setups and they are happy to short, knowing that only weak hands would be buying, and as they are flushed out, they will help drive the market down. A 1-tick failure is a reliable sign that the market is going the other way, so look for setups that allow you to enter. All of the above is true for down markets as well, and all of the 1-tick failures can sometimes be 2 ticks, and even 5 to 10 ticks in a $200 stock. Here in Figure 9.1 are 6 examples of 1-tick false breakouts. The label for bar 1 is well above the bar. Once the breakout traders enter on their stop and discover that the market is pulling back by a tick or two, instead of immediately continuing in their direction, they start to place protective stops, and countertrend traders smell the blood and will enter just where the trap traders are taking their losses. There were many examples of 1-tick traps in these 2 days in the E-mini, in Figure 9.2. Bar 1 is a 1-tick failed low 2 in barbed wire. Bar 2 is a 1-tick failed high 2 in barbed wire that trapped traders who thought that they were being conservative by waiting to buy above the large outside bar, only to be trapped buying at the top of a trading range below a flat EMA. Bar 3 was a 1-tick failed reversal in a runaway bull where smart traders were eagerly waiting for any pullback to buy here, a high one. Bar 4 broke 1 tick below the small swing low of 4 bars earlier. Bar 5 was a large bull trend bar, and there would therefore be stops at 1 tick below its low. These were run by 1 tick on bar 7. Bar 9 went 1 tick lower, trapping traders into what they thought was a lower high short but actually was a sideways bull flag. Bar 10 ran the break-even protective stop for the bar 6 shorts by 2 ticks. Bar 14 is one of the most reliable 1-tick failures. A failed high 2 in what novice traders erroneously assumed to be a bull pullback. This is a perfect trap and lead to a strong down move not shown. They missed noticing the trendline break by the pullback to bar 11 and then the higher high test at bar 12. Also, there were 5 bear trend bars and 1 doji down from the high and no trendline break after the bar 13 high 1. This was not a good high 2 long setup since there was no prior strength. Remember, a high 2 alone is not a buy signal. There have to be signs of strength, and certainly not signs of a reversal, like a trendline break and reversal down off a higher high. Horizontal lines are 1 tick beyond signal and entry bars, and are likely places where traders would place their protective stops. Look what happened in figure 9.3 when protective stops are hit beyond signal and entry bars. Most of the time, there is a trend bar, and the move is big enough for a scalper to make a profit. Many of the failures on this chart were for weak setups that smart price action traders would not have taken. However, enough traders took them so that they moved the market in the opposite direction, as they were forced out with a loss. For example, traders who went long off the bar 4 reversal would have their stops either below the entry or signal bars. Both were run by the big bar 5 bear trend bar, and smart shorts who had their entry stops at those exact locations made at least a scalper's profit. As a corollary, if the extreme of the bar is tested but not exceeded, the stops are tested but not hit, and the trade will often be profitable. If it is a protective stop on a long entry that is missed by 1 tick, the test effectively forms a double bottom bull flag, with the first bottom being the bottom of the signal or entry bar, and the second one being the bar that came back to that level but failed to reach the protective stops. Failed high/low 2. A high or low 2 is one of the most reliable with trend setups. If a trade fails, there will usually be at least 2 more corrective legs before a high or low 4 once again tries to end the correction. If a high or low 4 fails, the pullback might have become a new trend, and further price action is needed before placing more trades. The most common cause of a high or low 2 failure is that the trader is in denial about a strong trend and is looking for a counter-trend entry before there has been a strong trendline break. This is common after a climax reversal, and the trader is still looking to enter in the direction of the old trend, which no longer is in effect. These are not reversal patterns in strong trends and in fact are with trend setups. When they fail, they almost always result in a with trend entry. In a bull, a failed low 2 will often be a high 2 long entry. A triple bottom and a double bottom pullback are both failed low 2 long setups. In both cases, the market made 2 attempts to continue the bear downward, and both failed. Whenever the market tries to do something twice and it fails both times, it will usually do the opposite. The with-trend traders will wait for more price action, and the counter-trend traders know that they are in control, at least for a scalp. A low 2 setup is not enough reason to take a counter-trend trade in the absence of a prior strong trendline break. In fact, it will almost always fail and tum into a great with-trend entry, like a high 2 buy, as happened at bars 4 and 6 in figure 9.4. Before shorting a strong bull, you first need the bears to show that they have already been willing to be aggressive. You look to short their second attempt at pushing the market down, not their first, since the first usually fails. Today in figure 9.5, there was a gap down double top at bar 2 and then a new low. At this point, traders do not know if the 2 legs down to bar 3 ended a move or if there is more to come. The first leg was from yesterday's close down to bar 1. Although the bar 4 low 2 short reached its scalper's profit target, and therefore could not technically be a failure, the break below the trend line and the reversal up made it likely that the market would behave like a failed low 2 and have at least 2 more legs up, and then attempt to form a low 4 bear setup. There were a couple of problems with the low 2 short at bar 4. First, it followed a trendline break, the rally up to bar 2, which meant that bar 3 could be the low of the day, a bad place to be shorting, since the high or low of the day usually develops in the first hour or so. Next, the low 2 was too far from the EMA and therefore not a good EMA test. Normally, second tests of the EMA are closer to the EMA or penetrate it more than the first, and the first test at bar 2 was clearly closer. Many traders won't feel comfortable entering with trend unless the pullback touches or comes within a tick or so of the EMA. When the reversal begins before this happens, it will be missing the fuel that those shorts would have provided. Bar 6 formed a low 4 setup and was the second push above the EMA. However, this rally had many overlapping bars and several dojis, indicating that the bulls and bears were fairly balanced, and a big, fast move down was unlikely. Therefore, trading at this point might not be worthwhile for traders who prefer high-probability trades with big profit potential. The solution: either wait for more price action, knowing that good setups will always come if you can be patient, or take the short but be prepared to allow for a pullback, like the one on the bar after entry. Bar 2, in figure 9.6, took out the right shoulder of a head and shoulders bottom, a failed attempt at a higher low, and this led to a strong resumption of the bear trend. Bars 3 and 4 had strong breakouts above the right shoulder, lower high of head and shoulders tops. Bar 1 attempted to rally above the lower high right shoulder and failed, creating a double top bear flag setup. Most reversal patterns fail and become two-legged pullback continuation patterns. Note the large bars and strong momentum in figure 9.7 when the right shoulders are taken out, the break beyond the line drawn across the right shoulder, forcing out reversal traders with a loss, and also indicating strong with trend traders entering on the failed higher lows in the bear leg and the failed lower highs in the bull leg. Failed higher high and lower low breakouts. Most days are trading range days and offer many entries on failed swing high and low breakouts. You can also fade new swing highs and lows on trend days after a minor trendline break and when there is a strong reversal bar. When the price goes above a prior swing high and the momentum is not too strong, place an order to short the higher high at one tick below the low of the prior bar on a stop. If the order is not filled by the time the bar closes, move the order up to one tick below the low of the bar that just closed. Continue to do this until the current leg gets so high and has so much momentum that you need more price action before shorting. That can be in the form of a second entry, a low 2, a nominally higher high, or a pullback that leads to a trendline break, and then another higher high. It is far more reliable if you wait for a signal bar with a strong bear close, and beginners should restrict themselves to this type of fade setup. Similarly, the first failed breakout below a prior swing low is a lower low buy setup, and you place an order to buy at one tick above the high of the prior bar on a stop. Again, the odds of success are greater if the setup bar is in the direction of your entry, so it is best to wait for a bull reversal bar before buying. If your order is not filled, keep lowering the order to one tick above the high of the prior bar, but if the market drops too far or too fast, wait for a second entry, a nominally lower low, or a pullback and another lower low setup. The rally to bar 1 in figure 9.8 is strong, but since opening reversals are often sharp and it is a higher high above the swing high near yesterday's close that broke above a bull trend channel line, it is a reasonable short. The short entry is either on the outside down bar or below the inside bar that followed it, which is a better choice since outside bars can be unreliable. The bar 2 pullback after the bar 1 swing high is deep, and the bars today have been large with big tails. There is two-sided volatile trading, and until a bull clearly develops, traders should assume that both bulls and bears are active. Since this has not proven itself yet to be a bull trend day, it should be traded as a trading range day. Bar 3 is a higher high since it is a swing high that is above an earlier swing high. The momentum up to bar 3 is too strong to consider a short without a second entry or a strong reversal bar, but if a trader shorted, the move down was 26 cents, so it could have been minimally profitable. Bar 5 is a higher high and a reasonable short, especially since it has two small legs. There was a bear trend bar in the middle that represents the end of the first leg up from bar 4. The market dropped only 18 cents before going back up. A nimble trader might have taken some off, but most would have just scratched the trade with a 4-cent loss. Bar 7 is part of this same up move, so it was a second entry, a low 2 short. Bar 7 was a double top with bar 5 to the penny, and essentially a truncated 3 push-up pattern bars 3, 5, and 7, so 2 down legs should be expected. Bar 10 was a lower low and the second leg down in a possible larger bull. Its low was above the bar 2 low, so the market might still be forming large bull trending swings. 2 legs down in a bull or sideways market, especially 2 pushes below a fiat EMA, is always a good long. Bar 11 is a higher high because it was above the bar 9 swing high, even though bar 9 was part of the prior down leg. There will still be traders who will trade there. There will be stops on shorts, stops to buy the breakout, and new shorts. Because going above any prior swing high is a sign of strength and a potential fade on a trading range day, look for breakouts to fail and signs of strength to lack follow through. Bar 13 was one tick below bar 11 and was a double top bear flag and therefore a short setup. It was 2 legs up from bar 10 and the second leg above a Fiat EMA. Bar 11 was the first. Bar 14 is a lower low for both the swing lows at bars 10 and 12. Incidentally, the longs from bars 10 and 14 are both failed overshoots of a bear trend channel line drawn from bars 4 and 8, increasing the chances of successful long trades. Amazon has been prone to having large 1-bar failed breakouts on the 5-minute chart, but even for Amazon today was unusual. After the climactic run-up on the open in figure 9.9 and then the large reversal down, the bulls and bears both demonstrated strength and increased the odds that any move by one side would be reversed by the other throughout the day. A trading range was likely. All of the labeled bars are failed breakouts. The tight trading range began after bar 3 and turned into a small expanding triangle that ended at bar 7 in the middle of the day that ended up trendless. By midday, it was clear that the day was small and sideways, which greatly increases the chances that all breakouts would likely fail. Bars 1, 2, and 3 in figure 9.10 were second entries on breakout fades. The trend bar leading up to the bar 3 top was very rapid and had big volume, sucking in lots of hopeful bulls who bet that there might finally be a trend. This is always a low probability bet on a small day, and it is much better to fade the breakouts or look for strong breakout pullbacks. The breakouts to the bar 1 low and the bar 2 high were weak tails, overlap, so it was likely both times that the breakouts would fail. The breakout that ended in bar 3 never had a breakout pullback to give the bulls a low-risk long, so the only trade was the second entry short. Apple is one of the best-behaved stocks for day traders. Like many other stocks, Apple will sometimes trap traders out of great trades by running stops at the start of a reversal. Here in figure 9.11, bar 2 broke below bar 1 by 1 tick before giving a second entry long on the next bar, after the bar 2 test of the bear low after the trendline break. The first entry was 2 bars before bar 2 at a high 2, but it followed 5 bear trend bars and was back into the tight trading range. It made sense to wait for more price action, and the failed breakout below the tight range was perfect. What made it especially good was that it trapped new longs out and immediately reversed up on them, so psychologically it would be difficult for them to buy. They will then chase the market up, entering late, adding fuel to the upswing. This is also a double bottom bull flag bars 1 and 2, failed trend lines and trend channel lines. Trend lines and trend channel lines should hold and lead to reversals away from the lines, indicating that they were successful in containing the trend. Sometimes one will fail to hold the price action, and the market will not stop and reverse on the test of the line. The breaking of a trend line has the opposite implication from the breaking of a trend channel line. The break of a trend line means that a possible trend reversal is underway, but breaking a trend channel line means that the trend has increased in strength and is now steeper. A trend line break is the first step in a trend reversal, and if the break is on strength, the odds of a successful test of the trend's extreme increase. For example, after a bear trendline break, the test of the low would likely form a higher low and then at least a second leg up, or a lower low and then at least a 2-legged up move. Steep trend lines with 1 or 2 bar false breakouts are reliable with trend patterns and therefore attract a lot of traders. However, whenever a reliable pattern fails, then there will be an unusually large number of trapped traders. The reverse move will likely be a profitable trade, and it can be sharp and result in a trend reversal. This is more common on 1-minute charts, but it is far better to not trade countertrend off 1-minute charts since most reversals fail. You should almost always trade in the direction of the 5-minute chart. Whenever a trend channel line fails, the market breaks through it instead of bouncing off it. You should assume that the trend is much stronger than you thought, and you should look for with trend entries. Bar 4 in figure 9.12 was a strong breakout of the bear trend line after the bar 3 lower low expanding triangle bottom, so traders will look for a pullback and then a second leg up. A higher low can be followed by only a single up leg since that leg is already the second leg up from the low at the start of the move. Bar 8 was the break of another bear trend line, so a test of the bar 7 low should result in a long. A lower low usually is followed by 2 up legs. Bar 9 is also a higher time frame higher low compared to the bar 3 low. For example, bar 1 in figure 9.13 broke above a steep 3-bar micro trend line and then had a good short entry at 1 tick below its low. Bar 3 was a strong bull reversal bar break above a steep micro trend line and therefore was a bear setup. Any break above the trend line, even if it is by a strong bull reversal bar, is a setup for a short. And a short was triggered below the inside bar that followed. Bar 3 followed a break below in Roman 2, a possible failed final flag. But the Roman 2 did not break the trend line, and there was no other sign of bullish strength, so longs would want a second entry, which they got on bar 4. Although a nimble scalper might have been able to make some profit on the 29-cent breakout to the bar 4 low, it would have been difficult, so this is effectively a failed failure. The market failed to make an easy short scalper's profit after it failed to break above the bear trend line. Failed failures are usually good for a two-legged move, and when it occurs with a micro trend line, it operates like a breakout pullback long setup, even though it is a lower low. There was a small two-legged rally after the entry on the bar 4 outside bar. That prior bar was the entry bar for the short from the failed micro trendline break, and there are always stops above short entry bars, making the bar 4 long even more certain. Bar 6 broke above a steep micro trendline, setting up a short, which failed on bar 7. Bar 7 was also a high 2 in a trading range or weak bull, and arguably a bull flag double bottom with bar 5. Bar 1 in figure 9.14 broke above a steep micro trend line, but there was no pullback bar to set up a short. General convention for trading outside bars is to place entry stop orders at 1 tick above its high and 1 tick below its low and enter on whichever is filled. However, in general, you should wait for more price action, which is obviously what most traders did, as seen by the sideways action. Bar 2 was a second attempt to rally above that trend line, and so was a reasonable long entry, independent of the meaningless small sideways outside bar 1. It was effectively a breakout pullback long entry following the bar 1 breakout above the micro trend line. The next 3 bars tried to pull back but failed all, had the same low and none was able to trade below the prior bar, which is a sign that the bulls were taking a stand. Bar 4 in figure 9.15 completed a 3 push-down move from bars 2 and 3, and also bounced off a bear trend channel line from bars 1 and 3. However, the market went sideways rather than up. The bulls were not strong, so what appeared to be excess bearishness was not an excess at all. When a climax pattern fails to form any counter-trend momentum, then assume that you read the market wrong and are looking to trade in the wrong direction. Bar 8 was a bull reversal bar until the final seconds when it quickly sold off into a bear trend bar. What overly eager bulls thought was going to be a bull reversal bar at the bottom of a wedge and 2 bear trend channel lines turned into a bear breakout of the bear trend channel lines, which means that everyone now agrees that there is much more to go. This is confirmed by the series of bear trend bars that followed the wedge reversal failure. If you watched the market action, you would have seen the bull reversal bar collapse into a bear trend bar, and you then would have shorted it, knowing that there were trapped early entry longs who bought what they thought was going to be a strong bull reversal bar off a bear trend channel line. Don't front-run the bars. Always wait for them to close and the next bar to confirm the reversal. Even without knowing this, shorting 1 tick below the low of that bear trend channel line breakout is still a smart trade. Bar 11 was another 3 push-down pattern, but with all of those dojis and overlapping bars, a second signal was needed for any long, and traders should be looking for a small bar near the high of the barbed wire to short like bar 12, which clearly trapped longs on the breakout from the bull reversal bar entry 1 bar earlier. Bar 12 was a bad bull reversal bar because it had too much overlap with the prior bars, forcing you to be buying near the high of a bear trading range. Remember, buy low, sell high. This has been a very strong bear trend day, and the best traders would not be looking for wedges. Instead, they would be looking to short near the EMA. Since there were so few opportunities, the bears were very strong and smart shorts would be selling every failed buy signal as well as low 1 and low 2 entries. Bar 3 in figure 9. 16 broke above a steep micro trend line, setting up a short. However, the failed trendline breakout failed 2 bars later at bar 4. Technically, it did not fail because it reached a scalper's profit, and a failed failure is always a good setup here, a breakout pullback long. The trend is strong in figure 9.17, and you are missing all of the with trend shorts because all you are seeing are trend channel lines and potential reversals in what you believe is an overdone sell-off in a trading range day. Channels in spike and channel patterns always look that way. Be patient and only trade with trend until there is a reversal that is so clear and strong that you don't need to draw the line to see the excess, like the large bar 6 that reversed yesterday's low and was a 3 push-down pattern bars 4, 5, and 6. Don't trade what you believe should be happening. Only trade what is happening, even if it seems impossible. Failed reversals. All patterns fail, no matter how good they look. When they do, there will be trapped traders who will have to exit with a loss, usually at 1 tick beyond the entry or signal bars, and this is an opportunity for smart traders to enter for a low-risk scalp. Place your entry stop order at exactly the same place that these trapped traders are placing their protective stops, and you will get in where they will get out. They won't be eager to enter again in their original direction, and this makes the market one-sided in your direction and should lead to at least a scalp and usually a 2-legged move. Most are tradable, but always scalp out part of your position and move your stop to break-even in case the pattern fails. Bars 2 and 4 in figure 9. 18 formed a double top bear flag that failed, and the market then formed a bars 3 and 5 double bottom bull flag. You then had to reverse again at the bar 4 and 6 double top bear flag, but you would have netted 70 cents from your long. At this point, you knew that the market was forming a trading range, likely a triangle. R7 was another failure, but a good long since trading ranges following a strong move. The rally to bar 1 are usually continuation patterns, and bars 3, 5, and 7 all found support at the EMA. When the prices are holding above a rising EMA, always look to buy above the high of the prior bar if that bar touches the EMA, especially if its close is in your direction. Sell-off to bar 9 was 7 bars long with no bullish strength, so it would be better to wait for a second entry, despite bar 9 being a higher low compared to bar 7. The breakout pullback at bar 10 was a perfect second entry long after the micro trendline breakout to the upside failed. It only gave the shorts a scalper's profit, and the failure failed at bar 10. R4 in figure 9.19 was a setup for a double bottom bull flag entry, but it failed with the bar 5 M2S breakout pullback, which led to 2 legs down. You could either short the M2S, or you could sell on a stop at 1 or 2 ticks below the bar 4 low. When the market makes 2 attempts to do something like rally off the price around the low of bar 2 and fails, bars 5 and 11 in figure 9.20 were right shoulders of head and shoulder bottoms, most of which fail, as they did here. The shape alone is not enough reason to place a countertrend trade. You always want to see some prior countertrend strength prior to the reversal pattern. Even then, there are no guarantees that the trade will be successful. R2 broke a trend line, and the rally to bar 4 was strong, although its failure to exceed the bar 2 high was a sign of weakness. Although most smart traders would not have reversed to short at the bar 6 failure after the bar 5 double bottom bull flag long entry, they would have moved their stops to break-even, thinking that if the stop was hit but the trade was still good, the stop run would set up a breakout pullback long setup. Here, the stop was hit, but the market kept selling off. The 1-bar breakout pullback just after the breakout below bar 5 was a great short. The bar 11 right shoulder was a buy, but again the break-even stop would have been hit. The sell-offs to bar 2 and to bar 6 in figure 9.21 broke major trend lines, so a 2-legged test of the prior high should set up a good short. The bar 3 low 2 short was successful, either by shorting below bar 3 or taking the second entry 2 bars later. The bar 8 short is less certain because the test was a large bull trend outside bar, almost outside, since it had the same low as the prior bar. The traditional way to enter after an outside bar is on a stop at 1 tick beyond both extremes, getting filled in the direction of the breakout. However, outside bars are basically 1-bar trading ranges, and most trading range breakout entries fail. You should only rarely enter on a breakout of an outside bar because the risk is too great to the opposite side of the bar, which is large. If you shorted at the bar 8 breakout of the inside bar, you would be nervous by the bar's close, a doji bar, indicating no conviction. However, most traders would not have taken that short because 3 or more sideways bars where at least one is a doji usually create too much uncertainty, barbed wire. The 2 small bars before the outside bar were small enough to act like dojis, so it is best to wait for more price action. However, if you did not short on bar 8, you would have to believe that many did, and the doji close of their entry bar has these traders feeling uncomfortable with their positions. They will be quick to exit, and are therefore trapped. They will likely buy back their shorts at 1 tick above the bar 8 entry bar and be reluctant to sell again until they see better price action. With the shorts out of the market and with them buying back their positions, going long exactly where they are exiting bar 9, 1 tick above the short entry bar should be good for a scalp and likely 2 legs up. Either buy bar 9 at 1 tick above the doji inside bar or above the bar 9, relying on bar 9 being a bull trend bar and therefore a good long signal bar. Failed final flags, tight trading range. A protracted trend often forms a horizontal flag that extends sideways for several bars, breaks a trend line, and then breaks out to a new extreme but quickly reverses in the next few bars. This failed final flag breakout often marks the end of the trend and sometimes leads to a reversal. In most cases, there will be a tradable extended countertrend move that will have at least 2 legs. A key point is that the flag is usually mostly horizontal and often can be as simple as in Roman 2 pattern. A horizontal area is an area of 2-sided trading where the buyers and sellers are evenly balanced, and therefore this area acts as a magnet that pulls each little move up or down back to the center or opposite side. For example, after an extended bull move, if the bulls seize control and push the market up, they will likely be quick to take profits, and the bears will be confident that the prior trading range, flag, was an area of balance and therefore likely to be tested. Usually, the bulls will be reluctant to be aggressive again until after at least a 2-legged correction that extends well below the flag breakout failed. A micro trendline breakout pullback is something of a failed final flag. For example, when there is a break above a bear micro trend line and the market reverses down, but the sell-off fails within a bar or two, the break above the trend line is effectively a failed final bear flag. Sometimes, a failed final flag reversal just leads to the development of a larger flag with a wedge shape. For example, in a failed final flag in a bull, the first leg of that flag is the lowest bar of the wedge. The second leg is the bar that reversed the market down below the flag, and the rest of the wedge is the 2 or more legged sell-off down. This is now a larger bull flag that usually leads to a bull breakout. The flag may become a larger failed final flag, or just a continuation pattern in a larger bull. Bar 1 in figure 9.22 ended 2 legs down from the open and was therefore a possible low of the day. It broke out of a sideways bear flag after a protracted move, so this could be a failed final flag and a reversal up. Bar 1 was a good reversal bar, triggering the failed final flag long, causing traders to expect at least 2 legs up. The bar 4 breakout above the open was on strength and led to the formation of a tight trading range in figure 9.23. This often becomes the middle of the up move. Here, the strong breakout of the flag ended at bar 7, which was a 2-legged move up. Bar 5 was the first leg. 2-legged moves out of flags often set up a major reversal that typically has at least 2 legs. Instead of seeing bar 6 as a breakout pullback long, you could read it as still part of the horizontal pattern and the end of the first leg down from the bar 5 high. The bear bar after bar 6 becomes the second leg down, and buying above its high is reasonable since you are buying after 2 attempts down and a bull failed. Always be thinking about what is taking place. The move down to bar 10 was in 2 legs, but it only had a single countertrend bar 9, which means that it was likely going to be just the first leg of 2 larger legs. The bar 9 interruption was not strong enough to be considered the end of the first leg. In any case, if a short trader is unsure, he could move his stop to break-even. Also, an outside bar at the start of trend should be considered as the true beginning of the trend, and there will usually be at least 2 legs down following the outside bar, so the high 2 after bar 10 is actually just a high 1. Also, it was a micro trendline short and therefore should be viewed as low 1. Bar 11 failed to run the stop, and the high 2 at the EMA M2B failed, as expected since it functionally was just a high one, resulting in a strong bear. It was easy to anticipate that this high 2 would fail because smart traders would be regarding it as a high one, and the higher high at bar 7 followed a trendline break, so the trend should be considered down at this point. Smart traders would not be looking to buy a high 2, especially after an outside down bar, and especially since 2 clear down legs are likely. In hindsight, the bar 4 trading range turned into a failed final flag in the bull move up from bar 1, but smart traders would have anticipated this possibility and swung part of their short. Failed final flags, huge trend bar. Sometimes a final flag can be only 1 or 2 bars long. This is common when the market is moving fast with unusually large trend bars. The breakout from that small flag often reverses after a bar or 2, and this usually results in a 2-legged pullback that lasts for an hour or more. This is a tradable countertrend setup, but it does not reliably lead to a trend reversal. The strong momentum demonstrated by those large trend bars usually is followed by a test of the trend extreme. Bar 3 in figure 9.24 was a huge bear trend bar that followed 4 other strong bear trend bars after the market gapped above the bear trend line. The break of the bear trend line alerts traders to look for a test of the bar 1 low of the bear to see if the sellers fail again around the same price level. Bar 4 was the setup for a short off a small bear flag and the micro trendline low 1. Given the climactic behavior of the market to this point in yesterday's trendline break, traders will be looking for this to be a final flag that will lead to a reversal up after a test of the bar 1 bear low. Bar 5 was another huge bear trend bar, and bar 6 was an Roman 2 long entry, with the expectation of a rally that will last at least an hour and have at least 2 legs up. Both Roman 2 bars had bull closes, which makes the chances for a successful long trade greater. The second leg occurred at bar 9 on the following day. The strength of the downward momentum demonstrated by the large bear trend bars usually makes traders push the market down for a test of the low within a day or 2. Although it is not shown, the bar 9 high lead to a sell-off later that day that went far below the bar 5 low. Bar 3, in figure 9.25, was a 2-bar pullback after a huge and possibly climactic bull trend bar, and therefore it is a possible final flag. Bar 4 was also a second leg up from yesterday's low. Bar 1 was the end of the first leg. Bar 4 was an Roman 2 setup for a failed final flag short that should be expected to lead to a 2-legged protracted correction, which it did. The bar 3 bull flag turned out to be the final flag, and its breakout failed and reversed down after bar 4. Note that the second bar of the Roman 2 pattern had a bear close, which is always desirable when a trader is looking to short. The first bar also had a bear dose, but the second bar is always more important because it is the more recent history. The strong momentum up to the bar 4 high made traders drive the market up to test the trend extreme later in the day. Bars 3-5 evolved into a larger wedge-shaped bull flag. Bar 3 is the first pushdown and bar 5 is the third. 3 bars earlier was the second pushdown. The market then had a weak bull breakout of this downward sloping, wedge-shaped bull flag, but failed in a lower high at bar 6. A wedge flag can also lead to an extended bull move or become a larger failed final flag. Failed wedges. Wedges most often fail when traders are overly eager to enter countertrend, do not wait for a clear trendline break in countertrend strength, and fade the first small 3 push pattern that appears. 3 pushes alone, especially when small, will rarely reverse a trend in the absence of a prior trendline break or a major trend channel line overshoot and reversal. These wedges should be viewed as with trend setups, and smart traders will enter where the countertrend traders will be taking their losses. Sometimes after a wedge reverses, the reversal fails, and the trend resumes only to be followed by a failed breakout to a new extreme. This is a failed failure, which is a second signal and therefore likely to result in at least a 2-legged correction. For example, if there is a wedge top in a bull and the market drops a little but then reverses strongly to a new high, and that new high fails, this can lead to a strong bear move since it is a second failure by the bulls to push beyond this price area. The move down from the original wedge typically breaks the trend line, and the move to the new high is a higher high test of the bull top and therefore a short setup. The market tried to form a wedge reversal in figure 9.26, but bar 3 was the third overlapping bar in a row in an area of doji's barbed wire. This is acceptance of the lower price and not rejection, so it made a reversal up unlikely. Bar 3 entry bar was an outside-up bar that trapped bulls who overlooked the absence of a significant overshoot of the bear trend channel line and only saw the 3 pushes. A wedge is a type of climax reversal, so climactic behavior is needed for it to be effective. There needs to be a spike down and not a series of overlapping bars, a trading range or bear flag. When a wedge fails, the move will usually be an approximate measured move equal to the height of the wedge here. The move down below bar 3 was about the same number of points as there were from the top of the wedge, just after bar 1, to the bottom at the low of bar 3. The market was in a bear trend from the first bar on a gap-down day in figure 9.27. Overly eager bulls will rationalize buying the bar 2 wedge reversal by convincing themselves that it was the end of a two-legged move down, and there was a trendline break at bar 1. However, bar 1 was a failed trendline break and did not represent the bulls taking control of the market with any momentum. Bar 2 wedge long entry above the inside bar was a successful scalp, but not a setup that would likely tum into anything more. The bear micro trendline from the open to bar 2 is a sign of bearish strength. The move down to bar 2 did not have a meaningful trendline break or upward momentum in the middle, and therefore looked more like a single leg down made up of 2 smaller legs. There should be a second leg down after a break of the bear trendline before any meaningful rally could be likely. There was then a low too short at bar 3. This little rally did break a trendline so buyers could look for a scalp on a failed new low, which occurred at bar 4. However, in the absence of a strong bull reversal bar, this long was likely to fail, which it did at the bar 5M2S short, and the market then broke down into the second bear leg that ended at the bar 5 failed final flag, 1 tick false breakout. This was a trend from the open bear, which is one of the strongest types of bears, and smart traders would be forcing themselves to take every short and would not be taking longs. Bar 9 in figure 9.28 was a bear trend channel line overshoot reversal and a third pushdown, wedge. However, it was not a strong bull signal bar because it overlapped the prior bar too much and had a weak close, small bull body. There is no clear rejection of excessive selling. At best, you should wait for a second entry before buying. Also, there was no prior bullish strength in the move down from bar 5, so you should not be looking for longs. Bar 10 was a 1-tick failure for any traders who bought the wedge. It was the third sideways bar, so now smart traders are seeing a trading range in a bear, which is usually a continuation pattern. Overlapping bars mean that the market is accepting these lower prices, not rejecting them. You need a sign of rejection before you buy in a bear. Basing a trade on a belief that the market is overdue for a correction is a losing approach to trading. Trends can go much further than most traders could ever imagine. A trader could short the low one at bar 11, but this is a trading range, and smart traders will not short at its low without a stronger bull trap. It was a second 1-tick failed breakout. Also, a wedge usually makes 2 attempts to rally 2 legs up, so you should only short if the wedge failed, that is, fell below the bar 9 low, or if the second attempt to rally fails as it did at the bar 12 low too short. Bar 12 was a third 1-tick failed breakout in a row, but this time, it followed 2 legs up bars 9 and 11 and was low too short. This is the first trade that smart traders would take because it is a low 2 and a bear flag. What made it especially good was that there were 2 failed attempts to make the wedge reverse upward bars 10 and 12, and both failed. These represent the 2 legs up from the wedge, and they are clearly weak. Also, 3 1-tick failures in a row is very rare, so it is likely that the next move would run, especially since it was with trend in a trend day. A trader could also have waited to short below the low of bar 9 because it was only then that the wedge definitively failed. The heavy volume on the breakout, 14,000 contracts on the 1-minute chart, confirmed that many smart traders waited until that point to short. Traders would have recognized this day as a trending trading range day shortly after the breakout from the double top. It is usually safe to trade in both directions on this type of bear trend day, but the longs are counter-trend, so the setups must be strong. like those at bar 3 and 2 bars after bar 4, second entry long. To buy, you first need a trendline break, and it is better to have a reversal bar. Since bar 9 was a weak reversal bar and you are inclined to buy after a trend channel line overshoot and reversal, you could wait for a second long entry. Bar 12 was a second entry, but it was a purchase at the top of a 4-bar trading range, and you can never buy at the top of a bear flag. Once that weak second entry failed, the bears took control, and that was the trade that you needed to take instead of spending too much energy convincing yourself that the long setups were adequate. Bars 1, 2, and 3 in figure 9.29 formed a wedge reversal. Bar 4 broke above the trend line, but there was a lower low test of the bar 3 low. Sometimes wedges fail, and the failure fails, resulting in a lower low. This lower low is a reversal because it followed a trendline break at bar 4. Bar 5 also completed a larger wedge bottom. Failed scalps, 5-tick failed breakouts and failed to reach a scalper's profit target. In the E-mini, a very popular trade is a scalp for 4 ticks. In a trend, there may be a series of successful scalps, but when one hits the limit order and does not get filled, this 5-tick failure is a sign of a loss of momentum. These are also common on 1 and 3 minute charts. Since a 6-tick breakout is needed to make a 4-tick scalp, 1 tick for the stop entry, 4 ticks profit, and usually 1 more tick to be sure the profit target limit order is filled. A move that goes only 5 ticks and then reverses often indicates that the trend traders have lost control and a pullback or reversal is imminent. There are comparable failures in other markets that have many scalpers, like the SBY and the QQQQ. For both, a common profit target is 10 ticks, which usually requires a 12-tick move beyond the signal bar. If the move only reaches 10 or 11 ticks, or even 8 or 9, and then reverses, it usually leads to at least a profitable scalp in the opposite direction, since the scalpers are trapped and will get out on the reversal of the signal or entry bars and add fuel to your trade. If a stock reliably reaches more than $1 on a scalp, but then falls just short on 2 attempts at the $1 target, then this is a good scalp in the opposite direction. Scalping short for 4 ticks was a successful strategy for almost 2 hours. However, the short from the bar 4 inside bar in figure 9.30 dropped only 5 ticks and reversed up. This means that many shorts did not get filled on their profit target limit order, and that the shorts were quick to exit at break-even, and certainly above bar 5. The market was testing yesterday's low, and it was the second probe below the trend channel line based on the trend line from bars 1 to 3. The bulls were looking for reasons to buy, and the failed short scalp was the final thing that they were hoping to find. Each of these 5-minute QQQQ trades in figure 9.31 reached between 8 and 11 ticks before failing. The protective stops would get scalpers out at around break-even in all of them, but it still was a lot of work with little to show. Clearly, however, there were many other profitable scalps, but it is tiring to scalp if there are too many unsuccessful trades, often making a trader lose focus and then miss profitable trades. On a clear bear trend from the open day, the best approach is to only trade with trend and look to sell M2S setups or simple low 2s. Your winning percentage will be high, allowing you to have a healthy attitude and continue to take entries. Opal usually yields $1 scalps. The moves are usually more than $1, allowing a scalper to take partial profits on a $1 limit order. Bar 2, in figure 9.32, extended only 93 cents above the entry above bar 1, and then set up a low 2 short. This low 2 means that the market failed twice to reach the target. With the market largely sideways and just missing a $1 scalp, a trader would likely reduce his profit target to about 50 cents. He would have been able to take partial profits on this 61-cent drop. Chapter 10. Day Trading. The first consideration in day trading is the selection of the market and type of chart that you want to use. It is best to trade stocks that are popular with institutions because you want to reduce the chance of manipulation by a specialist or market maker, and you want minimal slippage. There are so many great trades every day on any basket of 5 to 10 stocks that you won't have to resort to stocks with small volume that might carry additional risks. The more bars in your day, the more trades you will make, and the risk per trade will be less. However, you might not be able to read the charts fast enough to see the setups, and you might not have time to place your orders without an unacceptable level of mistakes. There is a mathematical sweet spot that you will have to determine based on your personality and trading abilities. Most successful traders can trade a 5-minute chart. Reading a 3-minute chart is very similar and offers more trades and smaller stops, but in general, it has a lower winning percentage. If you find that you are missing too many trades, especially the most profitable trades of the day, you should consider moving to a slower time frame, like a 15-minute chart. You can also use charts based on volume, like each bar representing 1,000 contracts or ticks, for example. Each bar representing 500 price changes or ticks, or simple bar charts. Line charts are also tradable, but a price action trader is giving up too much information when she cannot see bars or candles. In general, since your risk per trade is smallest when you day trade, you should be trading your maximum number of contracts once you are consistently profitable. Until then, you should trade only a single E-mini or even only 100 SPY shares. Warren Buffett was quoted as saying, "If it's worth a penny, then it's worth a dime." Once you have decided that you have a valid entry, you need to be prepared to trade a reasonable number of contracts. Traders are always thinking about the best way to maximize their profitability, and the two most important considerations are trade selection and position size. A trader should focus primarily on taking only the best 2 to 5 entries each day, which are usually second entries in the form of reversals at new swing highs and lows on non-trending days, maybe 80% of days, and pullbacks on trend days. Once a trader is consistently profitable, the next goal should be to increase the position size rather than adding lower probability entries. If a trader consistently nets only 1 point a day in the E-minis, but trades 25 contracts, this comes out to over $1,000 per day. If the trader can get up to 100 contracts, he will make $1 million per year. If he nets 4 points a day, that is $4 million per year. The E-mini and treasury bond and note markets can easily handle this size of trading. For very liquid stocks with prices over $100, an experienced trader can net 50 cents to $1 on most days, and these stocks can handle 1,000 to 3,000 share orders with minimal slippage. ETFs like the QQQQ can handle 10,000 share orders, but the daily range is smaller, and a more realistic daily net would be about 10 to 20 cents for a good trader, or a couple $100,000 a year. If a trader is managing a fund of $50 million and he was trading 1,000 E-mini contracts per trade, he might have to split his orders into 200 to 400 lot pieces, and he only netted a point per day. This would generate $10 million for his clients before fees. Concentrate on taking the best trades and then increasing your volume. Selecting a market. Price action techniques work in all markets, but most day traders prefer markets that have many entries a day on the 5-minute chart and can handle large position sizes without slippage. The 5-minute S&P E-mini futures contract can handle any order size that an individual trader can place. You will never outgrow it. Russell, however, is popular with some individual traders because they feel that it trends well intraday and the margin is relatively small for the size of the average swing. Most successful individual traders eventually want to trade more contracts than the Russell can handle without the worry of slippage. When starting out, you should consider trading the SPY instead of the E-mini. If the E-mini is trading around 1100, the SPY will be around 110.00, and a 4-tick scalp for 1 point in the E-mini is a 10-cent scalp in the SPY, i.e., each E-mini tick is 2.5 times larger than an SPY tick. One E-mini contract is identical to 500 SPY shares, and if you trade 300 to 500 SPY, you can scale out of your swing position and not incur too much risk. One advantage of the SPY is that the 10-cent scalp value feels so small and comes so quickly that it will be easier to place orders for swing trades than for scalps, which is a better approach when just starting out. Once you have increased your position size to 1,000 to 1,500 SPY, if you plan to continue to increase your size, switch to the E-mini, which can handle huge volume without slippage being a significant problem. When just starting out, you can scalp 100 SPY, and a 2-point E-mini stop is the equivalent of a 20-cent SPY stop, so your risk is just $20 plus commissions. However, you cannot scalp and make money in the SPY unless your commissions are minimal, like $1 for 100 shares. Also, you need an order entry system that allows you to quickly place orders. Otherwise, just swing trade until you are consistently successful, and then look to add some scalping. Also, until you are profitable, you should only watch a single market because if you are not yet able to juggle one ball, it is foolish and expensive to try to juggle many more. Almost every major stock is well behaved and tradable, and it does not matter which you choose. What does matter is that you limit yourself to a single 5-minute chart of a single stock until you are consistently profitable. Even then, you will likely make more money if you stick to a single market. I trade stocks in addition to E-minis because it entertains me and makes me feel more a part of the trading world, which is good for my mental health because I am such a trading recluse. However, I would make more money if I just traded the E-mini. Currency futures and the forks, and treasury bond and note futures can handle huge volume but give fewer entries than the E-minis on most days. Bonds and notes can have protracted trends intraday, so when a trade sets up, you can often enter and let it swing for hours. The Forex market usually doesn't offer many great trades during the E-mini day session, and since you don't want any distractions, it is best to avoid it during the day. The DIA and Dow futures are a little thin, so slippage can be a problem for scalpers. Just as the SPY is identical to the E-minis, the QQQQ is identical to the Nasdaq futures. Both can handle huge volume. The QQQQ is also very popular with day traders and can accommodate large orders. Many stocks trade very well intraday, and it is easiest to only trade those with an average daily range of several dollars and an average volume of 5 million shares or more. You want to be able to scalp 50 cents to $1 with minimal slippage, and you want the possibility that the swing portion can run several dollars. Currently, Opel, RIM, Goog, Amazon, GS, WAR, DUG, IG, and SKS are all good, but there are many others, and you can add or subtract from your list as needed. IG's price is only around $10, but it can easily handle 3,000 share orders, so a 30-cent swing is about $900. Later in the book, in the detailed day trading examples chapter, there are charts of many markets that demonstrate possible price action trading. Time frames and chart types. For a scalper, it is easiest to use a 5-minute candle chart for the E-mini. However, for intraday swing trading of the E-mini or stocks, a simple 5-minute bar chart works well. This is because on a laptop or a single monitor you can fit 6 bar charts on your screen, figure 10.1, each with a different stock, and each chart will contain a full day's worth of bars. If you use candles, which are wider than bars, your charts will only show about a half day of price action. An important reason for mentioning this is to remind traders that this approach works well with simple bar charts, especially when you are only trying to swing trade the best entries. The advantage of candle charts on the E-mini for scalpers is that it is easy to quickly see who owns the bars, especially the setup bar. Also, a lot of high and low 2 variants are not easy to see on bar charts. Do you think that you can trade smaller time frames like the 3-minute or even 1 minute? If so, try it with 100 SPY shares for a couple of hours. And look at the chart, and honestly ask yourself if you read the price action correctly and correctly placed your entry, stop, and profit orders on at least 4 of the past 5 most recent setups. If you did, you might be able to do it, especially with the 3-minute, but I have yet to meet anyone who can do it on the 1-minute, especially for the 40 to 50 trades that occur every day on that time frame, and then do it year after year. Be realistic. If this is a job, you have to be able to do it for the long haul, and it has to have minimal stress, and you have to be satisfied that you are doing it really well. The 5-minute is the sweet spot, and it offers at least 10 trades a day and gives you time to think about the setups and to place your orders. It can also handle whatever volume that you will ever trade. The 3-minute also works well, but it is likely that you will end up cherry-picking too often and your winning percentage will be less. When there is a trend, look to enter with trend on a pullback, like an M2B in a bull or an M2S in a bear. Also, after a strong trendline break, look to enter countertrend on a test, like a higher low or lower low in a possible new bull, if there is a strong reversal bar. Price action trading techniques work in all market and all time frames, so a trader has to make the obvious basic decision of which markets and time frames he should trade. The objective of most traders is to maximize profitability over the long run, and implicit in that is finding an approach that suits his personality. If a 5-minute E-mini chart offers a dozen good entries on average every day, and the 3-minute offers 20, and the 1-minute offers 30, and the risk size of the protective stop is 8 ticks on the 5-minute, and 6 ticks on the 3-minute, and 4 ticks on the 1-minute, why not trade the shorter time frames? More trades, smaller risk, more money. Right? Right, if you can read the charts correctly fast enough in real time to be able to place your entry, stop, and profit target orders at the exact prices correctly, and do this constantly for 7 hours a day, year in, year out. For many traders, the smaller the time frame, the more good trades they miss and their winning percentage goes down. They simply cannot scalp with this method fast enough on the 1 and 3-minute charts to be as profitable as they are on the 5-minute chart. So that should be their focus, and they should continually work on increasing their position size. The best trades often come as a surprise, and the setups can be hard to trust, and most traders simply cannot process the information fast enough. Invariably, they will cherry-pick and tend not to pick the very best setups, which are the most important ones to their bottom lines. The average size of a move on a higher time frame chart is greater than that on a smaller time frame chart. However, almost every higher time frame swing starts with a reversal on the 1 and 3-minute charts. It is just hard to know which ones will work, and it can be draining trying to take 30 or more trades a day, hoping for a big move. The very best trades on 1 and 3-minute charts lead to strong entries on 5 and 15-minute charts, and for most traders, it is much more profitable to focus on the best 5-minute trades and work on increasing their position size. Once they can trade successfully, they can make an incredible amount of money and have a very high winning percentage, which results in much less stress and a better ability to maintain the performance over time. Also, as your position size increases, at some point the volume will affect the market on too many trades on a 1-minute chart. As an extreme example, if you had a limit profit target order to sell 5,000 contracts at 2 ticks above the market, anyone with a price ladder would see the aberration, and you would have a difficult time getting filled on 10 to 15 trades a day. Also, entering that size on a stop would result in a tick or two of slippage, which ruins the risk-reward ratio of scalping. A trader can trade even 5,000 contracts per trade using price action, but not with the entry and exit scalping techniques needed for most of trades. May you someday have the problem of having to rethink your approach because your volume is adversely affecting your fills. The 1-minute chart can be helpful in 2 situations, but this is in theory and not in practice, and I strongly recommend against trading off of it. If the 5-minute chart is in a runaway trend and you are flat but want to get in, you can look at a 1-minute chart for high/low 2 pullbacks to enter with trend. The second situation where 1-minute charts are helpful is in swing trading trending stocks off the 5-minute chart. When stocks are trending, they are very respectful of the EMA, and with trend trades can be made off high/low 1 or 2 setups at the EMA, risking the height of the signal bar. Traders can reduce that risk somewhat by entering on the 1-minute chart on the first reversal after an EMA touch or penetration on the 5-minute chart. If you plot a 5-minute 20-bar EMA plotted on the 1-minute chart, you can quickly see the touches and then place the order. You actually need to plot a 90-bar EMA on the 1-minute as a surrogate for the 5-minute 20-bar EMA. Why 90 and not 100 bars? Because the EMA on the 1-minute averages every 1-minute close and not every 5th close, and the weighting of the more recent bars tends to make a 100-bar EMA a tiny bit too flat. To correct for this, use a 90-bar EMA, which is very close to the 5-minute 20-bar EMA. In actual practice, you will rarely have time to look at a 1-minute stock chart because of your focus on the E-mini. However, when a stock is strongly trending, you might occasionally take quick entries off the 1-minute. Let me again stress that I strongly recommend against ever looking at the 1-minute chart because it looks so easy that you will constantly keep trying to do it successfully, and you will constantly wear down your account over time. Don't do it. The thumbnail of the 5-minute E-mini in figure 10.2 shows that it went 11.75 points up off the open without a pullback. If a trader missed the trend from the first bar long, he would have missed the entire swing because there were no pullbacks. However, if instead he looked at the 1-minute chart, there were 3 high 1 setups, bars A, B, and C, where he could have entered. However, never look at the 1-minute and suddenly realize that those are reversals that can be shorted. You looked at the 1-minute for one reason only. To find high 1 and 2 long entries because there were no pullbacks on the 5-minute. Trading countertrend on the 1-minute will cost you money. In fact, those 3 long setups are at exactly the price that the 1-minute shorts would cover. And as they cover, they will become additional buyers, helping to drive the market up. This 1-minute chart in figure 10.3 of Opal during a strong bear trend day offered 3 good shorts at the 90-bar EMA, equivalent to the 5-minute 20-bar EMA, with low risk, the height of the bar. The thumbnail shows the strong 5-minute bear trend. The top chart in figure 10.4 is a 5-minute chart. The middle has 1,500 ticks per bar, 1,500 trades per bar, and the bottom had 20,000 contracts per bar. The bar closes on the first trade that makes the volume 20,000 or more contracts since the start of the bar. They have similar price action and all are tradable, but since the highest volume takes place in the first hour or so, the tick and volume charts are skewed, with many more bars per hour earlier in the day and in the final hour. Reports can lead to very emotional moves with big bars, outside bars, and several reversals. However, despite the emotion that the rapid moves and big bars generate in all traders, price action setups are still very reliable. In general, always swing part of the position with a break-even stop, because sometimes a swing will go much farther than you could ever imagine. The FOMC report was released at 11:15 a.m. PSD and caused emotional trading as evidenced by large bars in figure 10.5, outside bars, and several reversals within the next 30 minutes. However, price action traders who remember the basic rules did well. Bar 2 was a large bull reversal bar, but whenever there is a lot of overlap with the prior bar, a trading range might be forming and you should never be looking to buy at the top of a range. Instead, look for trapped traders, small bars, and second entries. Bar 3 was a great short scalp because there were trapped overly eager bulls who mistook the large reversal bar as a sensible long setup. Bar 4 was the second attempt to reverse the breakout below the low of the day formed at the open. Second entries are always worth taking, and a bull trend inside bar is as good as you are likely to get on an emotional day. Since this should result in at least 2 legs up, you need to swing part of your position. The initial stop is around the middle of the signal bar, and then 1 tick below the bar 4 entry bar once that bar closed. Then trail the stop below the low of the prior bar and eventually move it to break-even. Emotional days often lead to trends that carry much further than you would ever imagine, and catching one like this is much more profitable than the combined profit from many, many scalps. Here, the bull continued for almost 30 points, or about $1,500 per contract. Bar 1 in figure 10.6 was a false upside breakout on a gap-up day. Bar 2 set up a high 2 at the EMA and a trend channel line reversal. Bar 3 was a short on a failed breakout to a new high on a gap-up day that could lead to a test of the gap. The market usually tries to test gaps, so traders should look for opportunities to trade in that direction. Bar 5 was a low 2 at the EMA. Bar 6 was failed micro trendline breakout. Bar 7 reversed 2 bear trend channel lines, but was not a profitable long, leading you to believe that the bears are strong. Bar 8 was a failed trendline breakout, a double top pullback, a bear M2S, and a 5-tick failure long from bar 7. With so many factors favoring the shorts, it is no surprise that the market fell quickly. Bar 9 was a second attempt to reverse up from the bear trend channel line overshoot. Expect at least 2 legs up. Bar 10 is a questionable short because you are expecting a higher low and a second leg up. It turned into a 5-tick failure at bar 11, which is a reversal pattern. Bar 11 was also a failed trendline breakout and a higher low, and it followed a break of the bear trendline. Bar 12 was a failed bull flag breakout, but the short resulted in a 1-tick loss. Bar 13 was a failed failure and therefore a bull breakout long. It was also a high 2. Bar 14 was a low 2 at a swing high, and a trend channel line reversal and a double top bear flag with bar 5. Bar 15 was a low 2 at the EMA M2S, a failed trendline breakout from the bar 14 high, and a lower high after the bars 11 to 13 trendline breakout. Bar 16 was a M2S short. Bar 1 in figure 10.7 is a wedge long and a double bottom, but it would have resulted in a 1-tick loss for most traders. In general, a wedge bottom or 3 pushes down or any of many other names for this pattern will lead to 2 legs up. Bar 2 is a higher low and a micro trendline reversal. Bar 3 was an M2B. Bar 4 was a report that resulted in a false breakout to the upside failed final flag, and then an outside down bar. Traders would short below bar 3, where the longs would have their stops. Bar 5 was a breakout pullback. Bar 6 was a second attempt to reverse up from a new swing low. Bar 5 was the first, and it gave a second entry. Globex, pre-market, post-market, and overnight market. The same price action techniques apply in all markets, including overnight trading. The pre-market extremes are often targets that get tested during the day session. But it is not necessary to look at Globex prices when trading the day session, since very little is gained and the signals will be based on the day session price action. Bar 1 in figure 10.8 was a bull inside bar after the upside breakout and set up a long at 1 penny above its high 1. Bar 2 was a long at 1 cent above the high of the outside bar, which also broke below a bull micro trend line and reversed up. Bar 3 was a high 1 breakout long after a major trendline break. Bar 4 was a short. It had a reversal bar and was a failed breakout of the bar 3 bull flag, failed final flag. Also, the bar 3 flag broke a big bull trend line, indicating that the bears were gaining a little strength. Only fade a strong trend if there was first a trendline break. Also, a countertrend trade in a strong trend needs a 5-minute, not a 3 or I-minute, reversal bar. Market went sideways for the rest of the post-market session. The E-mini in figure 10.9 reacted poorly to the 5:30 a.m. PST unemployment report. Note that the 30 bars between bars 1 and 5 all occurred within 1 minute due to the fast action off the report. These bars were forming so rapidly that it would have been impossible to trade anything other than market orders. It was theoretically possible to make many profitable scalps based on the price action, but traders should never attempt to trade this. The only purpose of showing it is to demonstrate that standard patterns are present throughout. The thumbnail charts are the 1 and 5 minute for the same 30 minutes of trading. This Globex bar chart shows an expanding triangle ending at the bar 5 high in figure 10.10, and the thumbnail is the day session with the same numbering. A day session trader did not need to see the Globex expanding triangle to go short at bar 5. Bar 5 took out yesterday's high and reversed down to the EMA, bounced to a low 2 lower high short, and then again to the bar 6 double top bear flag. The first top was 6 bars earlier. Scalping, swinging, trading, and investing. An investor is someone who buys stocks based on fundamentals and plans to hold the stocks for 6 months to many years, allowing time for the beneficial fundamentals to be reflected in the price of the stock. He will often add to his position if the stock goes against him, since his belief is that the stock is a value at the current price. A trader is someone who trades off daily charts and short-term fundamental events like earnings reports and product announcements with the intention of capturing a quick move, lasting from 1 to several days. He will take partial profits at the first pause and then move his stop to break-even on the balance. He is not willing to have a profit turn into a loss. Traders are sometimes referred to scalpers, but that term more commonly is used to refer to a type of day trader. In the eyes of a trader or investor using daily to monthly time frames, all day trading is scalping. However, to a day trader, scalping is holding a position for 1 to 15 minutes or so, and usually exiting on a limit order at a profit target in an attempt to capture one small leg on whatever time frame he is using for his trades. He does not want any pullbacks, and will quickly exit at break-even if the trade comes back before his target is reached, and he is therefore comparable to a trader on the daily charts. An intraday swing trader will hold a trade through pullbacks, and he tries to capture the 2 to 4 larger swings of the day, holding each position from 15 minutes to an entire day. He is comparable to an investor on the daily charts, who is willing to hold a position through pullbacks. To scalp the 5-minute E-mini chart effectively, you usually have to risk about 2 points and your profit target is 1 point or more. This means that you have to win on over 67% of your trades just to break even. However, if you read the charts correctly, this is achievable. Also, if you swing part of your trade using a break-even stop after taking partial profits, this reduces the required winning percentage. Finally, if you move your stop from the signal bar extreme to the entry bar extreme 1 tick beyond both after the entry bar closes, and then to break-even after a 5-tick move, this further reduces the required winning percentage to be profitable on the day. Finally, Some scalpers use a wider stop of 3 to 5 points and add on as the market moves against them, and then use a wider profit target, and this again further reduces the required winning percentage. Swing traders use the same setups and stops as the scalpers, but focus on the few trades each day that are likely to have at least a two-legged move. They can usually net 3 or more points on part of their position on each trade and then move their stop to break even on the balance. Many will let the trade go against them and add on at a better price. However, they always have at least a mental stop, and if the market gets to that point, they conclude that their idea can no longer be valid and they will exit with a loss. Always look for where scalpers will have their stops and look to add on to your position at that location, if the pattern is still valid. If you bought what you perceive to be a reversal, consider allowing the market to put in a lower low and then add on at the second entry. For example, with a reliable stock like Apple, if you are buying what you perceive to be near the low of the move and the overall market is not in a bear trend day, consider risking $2 to $3 on the trade and add on at a $1 to $2 open loss. However, only an experienced trader who is very comfortable in his ability to read and in his ability to accept a large loss if his read is wrong should attempt this. On most days, the market should go your way immediately, so this is not an issue. Most swing traders will scalp out if the trade is not unfolding as desired, and most scalpers will swing part of their position when they are entering on the best setups. So there is a lot of overlap in what both do. The fundamental difference is that the scalper will take far more trades, and most of those trades are not likely to yield more than a scalper's profit. And a swing trader tries to only take the trades that are likely to have at least 2 legs. Neither way is superior, and traders choose the method that best suits their personalities, and both yield about the same profit. It is reasonable to be primarily a scalper when trading E-minis, and a swing trader when trading stocks. For the E-minis, exit part or all of your trade on a limit order after 4 ticks of profit, which usually requires the move to extend 6 ticks beyond the signal bar. The entry is on a stop at 1 tick beyond the signal bar, then you need 4 more ticks for your profit, and your limit exit order usually is not filled until the price moves 1 tick beyond your target. 4 ticks in the E-mini is 1 point, which is equivalent to a 10-cent, 10-tick move in the SPY ETF contract. When it comes to stocks, there is much more variability in the size of the profit targets. For a $500 stock with an average daily range of $10, it would be foolish to scalp for 10 cents because you would likely have to risk about $2, and your winning percentage would have to be over 95%. However, scalping for 10 cents might be worthwhile in QQQQ, especially if you are trading 10,000 shares. It is relatively easy to look for swings in high-volume stocks, at least 3 million shares per day, but prefer 7 million or more that have an average range of several dollars. You want minimal slippage, reliable patterns, and at least $1 profit per trade. Try to scalp for $1 and then use a break-even stop on the balance and hold until the close or until a clear and strong opposite setup develops. You might be able to watch about 5 stocks regularly throughout the day and sometimes check on up to another 5 or so at different times during the day, but you will rarely ever trade them. An E-mini scalper will likely only be able to enter a couple stock trades a day since E-mini day trading takes so much attention. Also, only use bar charts for stocks, which allows you to put 6 charts on one screen. Just pick the one stock that is trending the best and then look for a pullback near the EMA. You can also trade reversals if you see a trend channel overshoot and reversal after there was a prior strong trend line break. If the E-mini market is active, consider only trading 15-minute stock charts, which require less attention. If you are missing too many good E-mini trades, it might be that you are getting distracted by the additional charts, and it is far better then to stop looking at them and only trade the E-mini. Although all stocks trade basically the same way, there are subtle personality differences between them. For example, Apple is very respectful when it comes to testing breakouts, whereas GS tends to run stops, requiring a wider stop. Baidu broke above the 15-minute trend line in Figure 10. Won late yesterday and therefore was likely to have at least 2 legs up. It was possible that the second up leg ended at bar 5, but today's open was so strong that there likely would be an attempt to exceed it after a pullback. The drop to bar 7 was sharp, But bar 7 was a strong bull reversal bar that reversed the EMA gap, the gap up open, and the test of the bar 3 high. It ran the stops below that high and turned up sharply. For a $300 stock, you need a wider stop, so trade fewer shares to keep the risk the same, but use a larger profit target on the scalp portion of the trade. $2 is a reasonable initial target, and then move the stop to break-even and exit by the close. When you are anticipating a significant move or a new trend, or when you are entering on a pullback in a strong trend, exit 25 to 75% of your contracts at a scalper's profit, and then scale out of the remaining contracts as the market continues to go your way. Move your protective stop to around break-even. Sometimes you will want to risk as many as 4 ticks in the E-minis if you feel strongly that the trade will remain good, and an exit, and then a re-entry approach will be at a worse price after you exit the scalp portion of your trade. A good trade should not come back to let late-comers in at the same price as the smart traders who got in at the perfect time. If the trade is great, all of the traders who missed the initial entry are now so eager to get in that they will be willing to enter at a worse price and will place limit entry orders at a tick or 2 worse than the original entry, keeping the break-even stop of the original traders from being hit. However, sometimes the best trades come back to beyond the break-even stop to trap traders out of what will become a huge, fast trend. When that seems like a possibility, risk a few extra ticks. Also, if it comes back and runs those stops and then immediately resumes the new trend, re-enter or add to your swing position at 1 tick beyond the prior bar. In a new bull, this is 1 tick above the prior bar's high. If the market touches the profit target limit order but does not go through it, and the order is still filled, that means that there might be more trend pressure than is evident on the chart, and the chances increase that the market will go beyond the profit target within the next several bars. If you were long and the market was willing to buy your position back from you, you were selling on a limit to take profits at the very highest tick of the leg. The buyers are aggressive and will likely re-emerge on any pullback. Look for opportunities to get long again. Similarly, if the market touches your profit target 5 ticks beyond the signal bar but you do not get filled, this can be a failure. Consider placing an order to reverse at 1 tick beyond the opposite end of the current bar once it closes. If you were long and the market hit 5 ticks above the signal bar and you were not filled, consider moving your stop to break-even. Once this bar closes, consider placing an order to go short at 1 tick below this bar, because that is likely where most of the remaining long scalpers will get out, providing selling pressure. Also, they will not want to buy again until more price action unfolds, thus removing buyers from the market and increasing the odds that the sellers will push the market down enough for you to scalp out of your short. A 5-tick failed breakout is common at the end of a protracted trend and is often the first sign of a reversal, always in the market. A good alternative to scalping and occasionally swinging a portion of the trade is to try to stay in the market most of the day, exiting on the close. Traders should focus on major swing points and reversals for entries, and either swing the entire position or trade at least 2 contracts, scalp 1, and then move the stop to break-even on the other. For E-minis, there are often stop runs and deep pullbacks, so it is preferable to scalp half and swing half, making sure that you get something out of every trade that reached at least a scalper's profit. For stocks, break-even stops have much less chance of being hit, so it is more profitable to look to swing trade. Typically, look to scalp out 1/3 to a half after about a $1 move, and then swing the balance. If the market appears to be reversing but has not yet reversed, like at a test of a high of the day, take off another 1/4 to a 1/3, but always let at least a 1/4 run until your break-even stop is hit, or until there is a clear and strong opposite signal, or until the close. Trends often go much further than you could ever imagine. Hold the position through repeated pullbacks unless the protective stop is hit, even if the pullbacks are violent. If it is hit, stay out of the market until there is another clear and strong setup in either direction. If there is a clear and strong setup, repeat the process. If your trading size is 2 contracts and you are long 1 when a reversal pattern triggers, sell 3. 1 gets you out of your remaining long position, and the other 2 start the process in this new, opposite direction. Scalp the first and swing the second. The key to this approach is to only enter or reverse when there is a clear and strong setup. If not, rely on your break-even stop, even though you may give back all of the gains on your swing portion. If you watch a small basket of stocks, almost every day at least one will set up with a reliable entry that will allow you to put on a swing trade. Apple had a gap test at bar 1 in figure 10.12, which was a strong reversal bar that reversed up after hitting a new low on the day and after breaking below a bear trend channel line. This was a great entry for a swing long that would have netted almost $4 by the close. R3 was a strong bear reversal down from the prior day's high and a bull trend channel line overshoot. There was a large bear trend bar, and this setup offered a highly probable trade for at least a two-legged move down. Bar 8 was a lower low test of the bar 6 low, and it followed a trendline break. It also tested a bear trend channel line and was a good reversal trade. If you simply exited your short instead of reversing to long, the trade would have netted about $2.40. The first day in figure L0.13 is a trading range day, and the always-in approach could have netted 52 ticks, or about $600 per contract. The second day began as a trend from the open and then entered a trading range. An always-in trader could have netted 79 ticks, or about $950 per contract. If a trader traded 2 lots and scalped 1 and swung 1, he could have had 10 successful scalps each day, yielding an additional $450 per contract per day. It sounds and looks easy, but is very difficult to do. Have at least 2 reasons to enter a trade. Some basic rules make trading much easier because once a rule is satisfied, you can act without hesitation. One of the most important rules is that you need 2 reasons to take a with trend trade or any trade in a trading range day, and any 2 reasons are good enough. Once you have them, place your order to enter, and once in, just follow basic profit target and protective stop-loss rules, and trust that you will be profitable by the end of the day. One important note is that if there is a steep trend, never trade countertrend, even if there is a high or low 2 or 4, unless there was first a prior significant trendline break or trend channel overshoot and reversal. Also, it is far better if the trendline break had strong momentum instead of just a sideways drift. Learn to anticipate trades so that you will be ready to place your orders. For example, if after a bear trendline break there is a 2-legged break below a major swing low or an overshoot of a trend channel line, look for a reversal. Or if there is a Roman 2 breakout, look for a reversal. Once you see an outside bar or a barbed wire pattern, look for a small bar at the extreme for a possible fade trade. If there is a strong trend, be ready for the first EMA pullback and any 2-legged pullbacks to the EMA, and for the first EMA gap pullback. There are only a few situations when you only need 1 reason to enter a trade. First, anytime there is a strong trend, you must enter on every pullback that does not follow a climax or failed flag breakout, even if the pullback is just a high or low one. Also, if there was a trend channel line overshoot and a good reversal bar, you can fade the move. The only other time that only 1 reason is needed to enter a trade, whether in a trading range or a trend, is when there is a second entry. By definition, there was a first entry, so the second entry is the second reason. Here are some possible reasons for entering a trade. Remember, you need 2 or more: reversal bar, good signal bar pattern, EMA pullback in a trend, especially if 2-legged, breakout pullback, breakout test, high/low 2 or 4. There must have been a prior trendline break if fading a strong trend. Failure of anything, prior high or low, flag breakout, reversal from an overshoot of a trend line or a trend channel line, 5-tick failure. Bar 2 in figure 10.14 is an M2B in a strong bull and is reason enough to go long. It was the first EMA touch in more than 2.5 hours in a trend from the first bar bull with a big gap up. It was also the first good trendline break, so a test of the high is expected. R3 was a lower high after a trendline break, and it followed the second failed attempt to break above bar 1. There was an Roman 2 setup, with the second bar having a bear close. Bar 5 was an M2S in a bear swing. There was a lower high at bar 3 and a lower low at bar 4. Bar 6 was a bear trend channel line overshoot and reversal, but there the setup bar was a bear trend bar, so 1 more reason was needed to enter. That came at the bar 7 higher low, which was a breakout pullback after breaking the micro trend line down from bar 5, not shown. Yesterday closed with a surge to bar 4 in figure 10.15, completing 4 legs of an expanding triangle. If you notice that, you would look for a long entry after a break below bar 3. R5 dropped below bar 3, completing the expanding triangle bottom, and now you just had to wait for an entry setup. There was a high 2 at bar 6, and bar 6 completed a down-up twin reversal, with an entry on the next bar at 1 tick above bar 6 on a stop. Entering on stops. A price action trader is looking for a reason to enter, and the bar that completes the setup is called a signal bar. The bar when you actually enter is called the entry bar. One of the best ways to trade using price action is to enter on a stop because you are being carried into the trade by the market's momentum, and therefore are trading in the direction of at least a tiny trend, at least 1 tick long. For example, if you are shorting a bear, you can place an order to sell short at 1 tick below the low of the prior bar, which becomes your signal bar after your order is filled. A reasonable location for a protective stop is at 1 tick above the high of the signal bar. After the entry bar closes, tighten the stop to 1 tick above the entry bar. A scalper in the E-minis usually needs a 6-tick move beyond the signal bar to scalp 4 ticks of profit. This is because the entry stop is 1 tick beyond the bar, and then you need 4 more ticks for your profit, and your profit target limit order usually won't get filled unless the market moves 1 tick beyond your order. Sometimes your order will get filled without the market moving through it, but when that happens, the market is usually strong and will likely move beyond that price within a few minutes of your fill. Similarly, to scalp 10 ticks in the QQQQ, you usually need a 12-tick move. When a setup looks weak, it is best to not take it and wait for another opportunity. If it is weak, it will likely fail and you cannot take needless risk. Often a weak setup will have a second entry, in which case it becomes a strong setup. Although most trades should be entered on stops when there is a strong trend, it is safe to enter anytime, and entering at the EMA on a limit order or on a 1-minute chart on a stop is particularly good in stocks, which tend to be well behaved. This allows for a smaller risk and greater reward, and essentially no change in the winning percentage. The entry stop is 1 tick above the bar 2 signal bars high at line A in figure 10.16, where you will be filled. Your limit order to take 4 ticks profit on your scalp is 4 ticks above that, at line B. Your limit order usually won't get filled unless the market moves 1 tick beyond it to line C, which is 6 ticks above the high of the signal bar. Bar 1 in figure 10.17 was a second entry short, a low 2 on the outside down bar following a test of yesterday's high. The run-up was strong and therefore it was better to wait for the second entry. Bar 2 was a high 2 following a large inside doji bar, but the down momentum was strong. It is better to wait for a trendline break before buying. Likewise, bar 3 was a bad second long entry because it followed a strong bear trend bar and you should still be waiting for a bear trendline break before looking to buy. The top of the day was a higher high after a trendline break, and the market has been below the EMA for many bars, so you should only be looking for shorts because the bull leg is now over. Trade what is there now, not what was there earlier in the day. Bar 4 was an M2S, but it followed 4 bars that almost entirely overlapped. In a tight trading range like this, you should never enter in either direction until after there is a large trend bar that breaks out of the pattern by at least 3 or 4 ticks, and then wait for that bar to fail, or unless there is a small bar that you can fade near the top or bottom of the trading range. Many of 1-tick false breakouts like those at bars 2 and 3 occur in the first minute or two of a countertrend 5-minute entry bar. Breakouts that occur in the final minute of the bar tend to be more reliable because you then have momentum right at the end of the bar. The chance of it continuing into the next bar is greater than if it occurred 4 minutes earlier and has since pulled back. Trading low probability trades will wipe out more than all of your gains. When a stock is in a strong trend like the trend from the open bear in figure 10.18, it is safe to enter on a limit order on the first couple tests of the EMA, or you can enter on the 1-minute chart with a price action stop entry at the EMA. At bars 1 and 2 in Opal, a second entry off the 1-minute chart at the 5-minute EMA plotted on the 1-minute chart had about a 25-cent risk, and the price action entry off the 5-minute chart insert had about a 45-cent risk. You could also short at the market on the first 5-minute close beyond the EMA and use about a 20-cent stop. Here, at bars 1 and 2, the market went only 4 cents above the close before reversing down. In general, it is better to either wait for the second 1-minute entry or use the traditional 5-minute price action entry on a stop below the bar that tests the EMA. Because there is very little gained by the other methods and they just involve more thought, which can distract you from your E-mini trading. Protective stops and getting trapped in or out of trade. The initial stop is 1 tick beyond the signal bar until the entry bar closes when it is tightened to 1 or 2 ticks beyond the entry bar. If the bars are too large, it is wiser to use a price stop, like 8 ticks on the E-mini 5-minute chart or a 60% pullback. For example, in a long off a large signal bar, you would place the protective stop about 40% of the distance up from the bottom of the signal bar to the entry price. The size of the money stop is in proportion to the size of the bars. For example, in the October 2008 bear, several days had ranges of over 40 points and required an 8-point stop, but this allowed you to use a 4-point profit target. You need to reduce your position size by 75% to keep your risk the same, but if you follow basic price action principles, you could make the same or even more than on a typical day. After the market reaches the first profit target and partial profits are secured, move the protective stop to about break-even, the entry price, which is 1 tick from the signal bar extreme. The best trades will not hit a break-even stop, and the majority don't go more than 4 ticks beyond the entry price on the 5-minute E-mini, for example, 3 ticks below the signal bar high after getting long. If the trade is good, the market won't come back to let timid traders come in at a better price. If it does come back, that is a sign that the trade might not be strong. If you are uncertain if today will be a huge range day and will require large stops, trade just 1 contract for the first 1 or 2 trades and see how large a stop would have been needed to keep you in the trade. Rely only on a stop beyond the signal bar, and once it closes, rely on a stop just beyond the entry bar. Once your 1-point profit limit order is filled, see how many ticks the stop would have had to be for it not to have been hit, and you can use this as your stop for the day. If the market would have hit a 14-tick stop but not a 16-tick stop, you could use a 4-point stop for the rest of the day, but reduce your position size by 50% and increase your profit target to 2 points. If after an hour or two the 2-point targets are not getting filled, you will likely notice that a 2 or 3-point stop is now working. If so, just go back to using a smaller stop and a smaller target and increase your position size back to normal. When a protective stop is hit before making a scalper's profit, you were trapped, so reversing on the stop is occasionally a good strategy. This depends on the context. For example, a failed low too short in a pullback in a bear is usually a good reversal into a long trade. However, a stop run in a tight trading range is not a reversal. Take time to make sure that you read the chart correctly before considering a trade in the opposite direction. If you don't have time to get right back in, wait for the next setup, which will always come before too long. After studying a market, you will see what a reasonable stop is. For the E-mini 5-minute chart, 8 ticks works well on most days. However, pay close attention to the maximum size stop required in the first hour because this often becomes the best stop to use for the rest of the day. If the stop is more than 8 ticks, you will likely be able to increase the size of your profit target as well. However, this provides a modest advantage at best unless the bars are exceptionally big. For example, if you are confident that a low will hold but a long trade would require a much greater money stop than you typically use, you can use the larger stop and then wait. If you are concerned enough about the extra risk that you can't take the trade, cut your position size in half and place the order. If the market hits your profit target without much of a pullback, take your profit. However, if it only goes a tick or so beyond your entry and pulls back almost to your stop and then starts up again above your entry price, raise your profit target. Be a general rule, the market will rally enough to equal the size of the stop that it required you to have to stay in the trade. So if the market dipped 11 ticks below your entry before reversing back up, only a 12-tick stop would have worked, and therefore the market will likely go about 12 ticks above your entry price. It would be wise to place a limit order to exit at a tick or 2 below, and when it approaches the target, move your stop to break-even and wait to see if your profit target order gets filled. There is one situation where you can often enter on a limit and not a stop. This occurs when you see a second entry after a trendline break and a strong reversal bar. For example, if you just bought and the market tests the exact low of the entry bar several times over the 1 or 2 bars, consider placing a limit by order to double your position at 1 tick above the low of the entry bar and risk just 2 ticks to the original stop, just below the entry bar. You would likely not get filled if you tried to buy the low of the entry bar on a limit order, since usually the market has to trade through the limit price for the order to get filled. Everyone knows that there are many protective stops just one tick below that entry bar low. Why isn't the smart money gunning for it? Because if those stops are hit, the character of the market will have changed. Instead of being a strong second entry, the chart now has a failed second entry, and that is a with trend setup and will likely result in 2 further legs down. If smart money had loaded up on the bottom, they do not want to see the market drop for another 2 legs, so they will do exactly as you did. They will continue to accumulate longs to defend the bottom. Eventually, sellers will give up and start to cover, and as they do, the market will rise well beyond the scalper's target. Do not place this kind of trade until you have been consistently profitable for a long time, because until then, you should keep your trading style simple, and you should not be thinking this hard. Once the entry bar closes, move the stop to 1 tick beyond the entry bar. If risk is too great, use a money stop or risk about 60% of the height of the signal bar. If you shorted on bar 1 in figure 10.19 below the double bottom twin, the 2 prior bars had the same low, the initial stop would be above the signal bar. Incidentally, this is not a good short since it is a pullback to the EMA on the open and has a high chance of rallying back up. The bar 1 entry bar reversed up immediately after entry, but did not exceed the top of the signal bar, so this would have eventually ended up as a profitable short scalp. Once the entry bar closed, move the stop up to 1 tick above its high. In this example, the signal and entry bars had the same high, so the stop would not have to be tightened. The bar 3 entry bar immediately sold off but did not fall below the low of the signal bar or below 60% of its height. If you used a money stop, thinking that this signal bar was too big to use a price action stop below its low. Once the entry bar closed, move the protective stop up to 1 tick below its low. 2 bars later, there was a pullback bar, but it did not hit the stop. If tested the entry bar low to the tick, creating a double bottom and a great trap, trapping weak longs out. Stop for the short at the bar 4M2S was not hit, despite a pullback bar 2 bars after entry. Given the large size of the bars, it would have been better to short below the low of the bear trend bar rather than simply on the low 2 below a bull trend bar. The stop is above the entry bar and does not get tightened to above the high of the most recent bar until after the market has moved about 4 ticks in your direction. If the trade time to work. Also, when the entry bar is a doji, it is usually safe to allow a 1-tick pullback. A doji bar is a 1-bar trading range and it is foolish to buy above a trading range, so don't buy back your short there. Rely on your original stop until the market has moved at least several ticks in your direction. The bar 5 high 2 long immediately sold off to test the signal bar low. This is evident on the 1-minute chart, not shown, forming a 2-bar double bottom and then a successful long scalp. Rely on your stop and ignore the 1-minute chart. When taking a 5-minute entry, rely on a 5-minute stop, else you will lose too often and be stopped out of a great many trades in your attempt to risk less per trade. Buy 1 tick, and then tested the tightened stop below the entry bar, but neither stop was hit. The dojis prior to entry increased the risk of the trade barbed wire, but with 6 closes above the EMA after the surge from a new low of the day, you had to be expecting a second leg up, and the M2B was a reasonable entry. An even better one was 4 bars later, above the small bear bar, because this was essentially a high 4 long, a second attempt at a high 2 out of the barbed wire. If a trader bought above the bar 8 Roman 2, the stop was hit on the entry bar, and this would have been a good reversal, as are most failed Roman 2 patterns. The buy was bad because a double top bear flag was setting up with bar 4, and you should not be buying near the high except in a bull trend. Also, most of the previous 20 bars overlapped several of the bars before them, giving the market a strong trading range quality. The move up from bar 7 was a small channel in a spike and channel bull. Therefore, you would not want to be buying at the top of the second leg up when that might be the end of the rally. If you shorted the bar 11 swing high, you could either have reversed on the bar 12 reversal bar that tested the EMA, or you could have reversed on a buy stop at 1 tick above the entry bar that followed the bar 11 short. The short from the bar 13 swing high, low 2 became a 5-tick failure and a failed low 2. You should reverse to long on bar 14 at 1 tick above the entry bar, the bar after the bar 13 signal bar, since there are trapped shorts and you should expect at least 2 more legs up. The sell-off to bar 1 in figure 10.20 was climactic and bounced up on a down-up twin bottom after breaking out of an inside bar failed final flag 3 bars earlier. If a trader bought above bar 1, not wise since it was a bear trend bar, he would expect a 2-legged move up and that the low of bar 1 would hold. In this strong a bear, it would make more sense to wait for a second signal, especially since there was not even a small prior trendline break. The bar 3 pullback dipped 1 tick below the entry bar 2 low, but bounced back up in a second down-up twin reversal that missed the signal bar 1 low by 1 tick. If a trader then bought above bar 3, he would know that bar 1 was an acceptable but risky long, and that the dip at bar 3 was 17 ticks, so an 18-tick stop would have been needed to stay long. Therefore, the trader could raise his target from 4 ticks to about 16 ticks. The second leg up ended at exactly 18 ticks above the entry price. When the risk is about twice normal, a trader should trade half as many contracts to keep the dollar risk the same. A sensible long entry would be to wait for bar 4 to close, and once you see that it was a strong bull trend bar, and you know that it was the second strong bull trend bar in 4 bars, and there is room to the EMA, an obvious magnet, enter on a buy stop at 1 tick above its high. Yes, this is buying the top of a bear flag, but here was good bullish strength and room to run to the EMA. A similar situation was present on the bar 6 low. Here the market was trying to form a double bottom bull flag with the bar 3 low, but bar 6 has a weak close. Conservative traders would not have bought at 1 tick above the high and instead would have waited for a second signal. After bar 7 closed, an acceptable second signal would be to buy at 1 tick above bar 7, which would be a second attempt to rally. But it also had a weak close, so this is not ideal. This bar 8 entry bar again would require a stop below the bar 6 double bottom bull flag low, which was also the initial signal bar, and it was only a couple ticks below the entry bar, so the added risk was worth it, given the likelihood of 2 legs up. Once long in bar 8, the stop would be 12 ticks, so it was likely that the move would extend about 12 ticks up. A target of 10 ticks was worth trying and proved to be successful. The market tested the bar 8 low in each of the next 2 bars, so the institutions were defending the stop, making a rally more likely. Bar 9 reached 12 ticks, and the market went 1 tick higher 2 bars later. A safer entry would be to buy above the bear inside bar that followed the bar 8 bull trend bar, because the strength of bar 8 showed that the bulls are willing to defend the bottom. A short off the bar 1 signal bar that poked above yesterday's high in figure 10.21 would have required 9 ticks, since after the entry bar closed, the stop would be 1 tick above its high. Bar 2 tested the entry bar high, and it would have hit an 8-tick stop but not a 9-tick stop. Remember that for the rest of the day. If you bought the failed low 2 at bar 3 and placed the initial stop at 1 tick below the signal bar's low, you would risk 8 ticks. 1-tick stop runs are common when there are dojis, and you know that a 9-tick stop was needed earlier in the day, so it would have been wise to risk the extra tick. This was not a great buy because it followed a tiny breakout, and the last 7 bars were largely sideways with several dojis, barbed wire. A second entry would be better. Today had a big gap in figure 10.22 down, so the day was likely to trend up or down. Following bar 3, the market sold off strong into a lower range, and by the time bar 6 formed, the day was a trending trading range day or a trend from the open bear. It is usually safe to buy near the bottom of every range in trending trading ranges and short near the top. Bar 5 broke above a micro trend line. Bars 4 and 6 were strong bull reversal bars, with bar 6 setting up breakout pullback long. The entry bar became a bear trend bar, which is a sign of weakness. If the market traded 1 tick below its low, this would have been a failure, and the market would likely have dropped quickly down in 2 more legs. Since smart money believed that this was a trending trading range day, and they bought the second entry bar 5 being the first, they will defend it by continuing to buy down to the low of the entry bar. They do not want the market to go 1 tick lower, because they will then have a losing trade. The market missed those protective stops by 1 tick many times over the next 15 minutes, and patient longs were rewarded.